Kicking off their holiday hiring, and for good measure, consumer spending is on the rise, with shoppers expected to spend 9% more on holiday purchases compared to last year. That's according to a new survey out of Stifel on consumer spending. Joining us now to add some insight is Stifel's Managing Director for the Consumer and Retail Sector. That is Mark Astrachan. Good to see you, Mark. Thanks for being here. I want to start with some of these hiring plans before we really dig into the meat of the survey, which was very interesting. Target saying it's going to hire 100,000 folks. Walmart only 40,000. I mean, what can we, if anything, read into some of these plans?
Yeah, thanks for having me. First off, I think it's probably a little bit hard to read into the plans specifically because you just don't know necessarily what the hiring levels are behind those. But yeah, I think generally speaking, it's encouraging to see at least that they're looking to hire folks and that they're actually finding folks to actually hire. Because if you recall, over the last year or so, it's been just a lot harder to find people to come into those jobs given where unemployment is. And so I think they're basically trying to get what they can. I think probably the fact that numbers aren't exceedingly above where they've been in the last couple of years would suggest that they're probably in a pretty good spot at this point to be able to service the customer adequately. And just as an aside, but I think interesting too, remember, a lot of the folks that they're hiring are not just doing kind of front of store, but they're also doing things behind the scenes to fulfill digital orders as well, like buy online, pick up in store, buy online, pick up in parking lot as an example. So you do need more folks than you did 5 years ago, but I think they're probably in a decent spot at this point.
What does that tell you, though, about some of their margin compression, perhaps what they're expecting based on the hiring levels that they have set forth and because they are so dramatically different from last year?
Well, I guess it's going to depend. Walmart's up 40,000, Target up 100,000, but again, kind of similar to prior year, and Walmart below. So I guess on a net basis, that's probably better if you have fewer people versus the prior year. But this year, the margins are not just hiring of people. Of course, there's all the inflation overlying everything else that's going on. And so all these companies have just seen a massive pressure on cost. On top of that, the slowing of general merchandise discretionary, however you want to put it, category sales in the fiscal second quarter, kind of May, June timeframe, that obviously weighed on margins there. So the expectation would be that things get better from a margin standpoint relative to where the lows were earlier in the year. So not necessarily a comment on the year on year in the holiday period, but certainly better than where we were in the July quarter, for example.
Yeah, and speaking of which as well, when we look at your spending survey, people, in terms of their spending intentions, net discretionary spending intentions, you guys found, were up 10% in mid-September. That compares to about a 6% increase since June. And I guess you can account for some of that with the lower gasoline prices. I mean, how do you tease out these spending intentions and account for higher prices as a part of that? In other words, if you ask someone how much more do you expect to spend, how much of their answer depends on how much more they think they're going to have to spend on the same stuff?
Yeah, it's a good question. It's not really one of those things that we get into a lot of specifics in asking folks what they think about the inflationary aspect of what they're spending relative to what they're actually spending. But inherent in that, obviously, is at least some level of inflationary pressure that goes into it. But I think really the high level just suggests that the consumer, regardless of what we're seeing and debating from a market and macro standpoint, that the consumer is actually feeling a little bit more robust or less influenced by kind of some of those higher level items. And to your point, I think the gas prices, it's really hard to kind of overstate what the impact was on higher prices in early June and obviously lower prices on a relative basis from there. And we asked the question on just how much impact you're seeing from gas prices on spending. And it's still inflated relative to historical levels. 60% of our respondents say that they're expecting some impact from their spending on gas prices, but that's down 10 points from where we were in June. And obviously gas prices are down materially since June, still up, I don't know, I think 15% or so year on year. So I think that's kind of what you're seeing here in terms of the overall spending. The lower gas prices really is helping the consumer kind of thinking about that. And the holiday spending kind of coupled with asking on back to school spending that we started in I think late July or early August show that you're actually seeing two improving spending intentions on just back to school, but also on a holiday, that those levels in terms of where our back to school spending ended, which was down a couple points versus a year ago, is much better than down high single digits where we were in early August when we started asking that question. So I think you're kind of seeing the consumer spending appetite increase as gas prices in particular come down, and then they're just dealing with inflation as they can, but there's not a lot you can do.
What type of divide in that spending intention are you seeing among different income brackets, perhaps, and especially as we've seen a relative resiliency in some of the higher income spenders versus the rest of the market, the rest of the economy and consumers that are trying to exactly determine where they can still spend on discretionary things versus kind of pulling it back in entirety? And is that starting to trickle into the higher income brackets as well?
Yeah, it's actually really, really fascinating. So we take the income levels and kind of look at those questions that we ask, a lot of the questions, but the very high level of spending, the high level of back to school and holiday. And what's really fascinating is it's been ongoing for a while that those earning less than $75,000 per year have, in absolute terms, said they're going to spend less on a year-on-year basis. And that got worse as we went through spring into early summer, peaked or troughed in June from higher gas prices, and has gotten better. So if you take a look at the most recent survey, those consumers, again, those earning less than $75,000 per year, say they're going to spend 17% less versus year ago versus the overall 10% number that you said. So it obviously tells you how significantly up the spending intentions are for those earning more than that. And if you take a look at the back to school and holiday, the same dynamics play out where those earning less than $75,000 are going to spend less. But interestingly, holiday spending intentions were actually higher relative to overall spending in each income level, including those lower income consumers. So suggesting that the lower income consumers are going to spend less year on year, but they're actually spending less than just the overall, or I should say they're spending more than the overall discretionary spending. So they're still planning on spending more just in absolute terms on holidays. So somewhat encouraging there. And I'll just add too that if you look at that under 75,000 level, it's, as I said, gotten better since June. I think that's probably the important takeaway here, that lower income consumer is feeling a little less pressure right now because of what the gas prices are.
Where are all these people going to spend their money, Mark? Just real quickly, what's your pick going into the holiday season?
I'm not sure I have one, but I think maybe broader strokes here, kind of punting the question. Discretionary spending has obviously been pretty weak in the first part of this year, and so I think you're going to see that those categories that were most weak probably come back a little bit more as we head into holiday.
Stifel Managing Director Mark Astrakhan joining us here today. Thanks so much for this survey, the insights, and breaking this down for us. Appreciate it.
Let's talk more about the Fed here with RBC Capital Markets Head of Rate Strategy, Blake Gwynn. He's joining us live in the studio. We heard about the enthusiasm, the tech spending that's continuing on out there on the part of Salesforce. Brad Smith was very excited about your FOMC recap title, your note title this morning, all about that pace. He was enjoying the Meghan Trainor reference, all about that pace from the Fed. And indeed, it is all about the pace, and that the pace is going to keep right on going. For how long and at what cadence can we expect the Fed to keep raising rates?
Yeah, I mean, I still remember back in June when 75 basis point hikes were still supposed to be something that was very abnormal. But here we are, X number of hikes later. And I think what the Fed did yesterday via the dots that they released, the forecast, basically told us that the 75 basis point pace of hikes is going to continue at least until November, which I think is notable because we, as recently as kind of pre-CPI report, we were expecting that turnaround to really happen at this meeting, but indeed another 75 and continuing into November. So that's really where we're looking for the downshift. But obviously, I think there's risk to the upside for that as well if we get continue to see very high CPI prints.
What parts of the market do you believe would be most heavily impacted by this new target that's set forth as well? As we were looking at some of the declines earlier, especially in the tech sector, as we've been continuing to track that too.
Yeah, I think on the equity side, it's really mostly the the heavy interest rate sensitive sectors, as you mentioned, tech sector. But as a rate strategist, I really think about the different parts of the yield curve, and there I think the front end is really what was susceptible to that dot plot yesterday, and that's really what we saw after the meeting, a very clear-cut response to this higher expected path of rates. The front end of the yield curve went considerably higher, but at the back end we actually saw, I think, some of that hard landing concerns and recession risk pricing itself into the back end with this kind of risk-averse move, pulling those yields further down. So for me, it's really about the front end pricing in that higher path.
With this outlook for rates, is there any outlook for rates on the part of the Fed? Is there any ceiling on what we're going to see from the short end of the curve, for example?
Yeah, I mean, I think at least, and again, back to the pace and the title you mentioned, I do think they've made it very clear that the ceiling is 75 basis points. I think 100 basis points has essentially been taken off the table now. We heard a little bit about 100 basis points heading into this meeting, but it never really kind of took sail in the way that some of the prior 100 basis point conversations have. So I think we've taken that off the table. I think also with the dot plot only showing a 25 basis point hike next year in the median forecast, I think that also kind of means that we're fairly priced at this point. So I mean, if you look at kind of where front end yields are, we're essentially pricing most of those hikes very accurately that the Fed has projected. So unless we see, again, some continued upside surprise in CPI, another really big print, or if we see Fed speakers come out and start to suggest that they need to do more 75s, I mean, those would really be the things that would, I think, take those front end yields higher. But for now, I think, we're probably fairly priced for the Fed path that we're expecting at this point.
In your note, you also mentioned that the press conference was only really notable in that Powell largely avoided saying anything notable. It's a job that none of us really envy having right now, being the Fed chair or being on the FOMC. But if there is anything that stuck out to you that was not mentioned that you expected to hear from the Fed at this point in time, what is that? Just so that we know to pay attention to that going forward from here.
No, I think Powell has perhaps learned his lesson a bit after the kind of dovish pivot debacle that we had after a prior meeting.
Do you think that's restored credibility in the Fed?
I mean, I wouldn't go so far as to say it restored credibility, but I think it was heartening to see that he did avoid some of these pitfalls yesterday. I think there were points in the press conference where it would have been very easy for him to kind of slip up as he continued to answer the question and say something that markets would have latched onto as something that was particularly dovish. But he sidestepped those landmines. And I think, in the past, we've seen him talk in circles to the point where he says something, markets see that as very dovish, and what we get is exactly the opposite of what the Fed wants, which is financial conditions loosening because now they expect the Fed to pull back. So he didn't do that. And I think Jackson Hole was the first time, we heard later on that he stripped down that speech. He took out all the extraneous stuff and said, this is my core message. It was extremely short, extremely tight. And he didn't have any of that kind of fluff around it that would risk markets coming away with that with a dovish impression. And he did the same yesterday.
Yeah, shorter than NFL quarter, for sure. And we expected a lot more at Jackson Hole. So it's extremely measured, it sounds like, that he's going to be going from this point forward. Blake, appreciate the time here this morning. And for the recap, it's RBC Capital Markets Head of Rates and Strategy. Appreciate the time this morning. Welcome back to Yahoo Finance Live, everyone. Let's battle it out in our bull versus bear segment for the week. The spotlight right now on Nike. Barclays Managing Director Adrian Yee, who just downgraded the athletic apparel brand to equal weight, alongside Evercore ISI Senior Managing Director Omar Saad, who maintains his outperform rating, join us now to make their cases. Okay, so I'm just going to kind of throw the jump ball here, but I do want to start with you, Adrian, because as I look through your notes here, you're looking really at some of the inventory risks and really looking more near term for your thesis around Nike. Kind of break down exactly what you're looking at near term here on the inventory side, and is that something that can be navigated through to get them into kind of a more bullish stature?
Yes. So the inventory issue is sort of near to medium term. We actually think from a kind of broader perspective, wholesale in general tends to follow frontline retail being those who sell directly to the consumer by about 6 months. So we always say that, frontline retailers will buy the out season to the rate at which they sold through the current season. So we think there's going to be a really, really tough holiday. And part of this is really about the forward 2023 purchasing behavior in the wholesale channel. Remember, Nike still has about 55% in the wholesale channel, even though they're making great strides in moving to DTC. So that's sort of the crux of kind of the near to medium term.
And Omar, just kind of staying on that same thread of inventory as of right now, I mean, you've sent us some interesting stats on particularly this sneaker super cycle here more broadly. Break that down for us and what we need to know about where Nike is sitting right now in that sneaker super cycle. I haven't had any issues trying to find the drops that are the latest and greatest, and perhaps that might be part of the issue in this near term that really feeds into the bear case.
Yeah, no, thanks for the question. Thanks for having me. Hey, Adrian. Look, inventory is a result of supply and demand. And as you know, we've come through a very strange supply period with everything ranging from factory shutdowns to port backups. And so Nike, along with many of the companies we cover, especially heading into the heavier back to school fall holiday season in North America, bring in inventory early to avoid the kind of supply backups that have been happening the last couple of years. I think 65% of their North America inventory is in transit, what was at the close of the last balance sheet. I think you back out some of those extraordinarily high in transit numbers, and the inventory levels start to look more normalized. And again, I think you pointed to the right equation. You know, we are in the beginning of a sneaker super cycle. There's this perception that sneakers have been booming for the last 3 years, and the reality is, you do a deep dive unit analysis, as we have in some of our recent research we sent you guys. There's been a dip in unit sales, even with the rise of all the new sneaker brands. We think there's still a lot of demand out there. People are wearing sneakers more. They're wearing through sneakers more. Their feet are absolutely used to the comfort that sneakers and other comfortable footwear brings during COVID, and are hesitant to go back to uncomfortable dress shoes on a daily basis just for special occasions. And they want to own more sneakers in their closet for different wearing occasions, not just to wear to work or to wear for workout. Sneakers are kind of almost becoming a highly specialized accessory, and Nike, we think is the best positioned company to take advantage of this massive sneaker super cycle. I'll say that fast 3 times.
Exactly. I want to shift gears and talk particularly around the world here, where we're looking at some of the relative strength that Nike may have in some regions versus others, where, Adrian, you've laid out that China still remains a near-term volatile landscape and a longer-term question mark here. How long do you believe it'll take for Nike and some of the other footwear brands, quite frankly, to really work through that volatility?
So the big question here for Nike in China is kind of the algorithm used to be sort of low to mid-teen growth on a CAGR basis, and they would, just every year beat that, right? So they were sort of more on this 20% plus. No one expects them to return to that, but we're really looking for them to return to positive growth. That could actually happen in the next couple of quarters. What we would say there is the landscape. There's a big question mark as to whether this is just sort of a short to medium term COVID transitory issue, or whether this has more of a bent toward sort of the rise of domestic brands, right? So the two kind of equivalent Chinese brands would be Li-Ning and Anta. And if you look at their first half yearly numbers, Li-Ning was up 22%. Anta was taking share, up 14% in the market. You compare that to Adidas, down 35%. And then for the first half of the year that we know of from Nike, down 12%. And so we think that this is a very sort of kind of uncertain time period. The good news is that upon the reopenings that we've seen sort of in the back half of September, you have seen a resurgence in their DTC business, the direct-to-consumer business. Adidas is taking about 400 million euro or $400 million worth of inventory back, right, out of that channel. So they're reversing forward sales. There's just quite a bit of inventory, a lot of promotions in that China marketplace.
From one of the very real marketplaces, the IRL marketplaces, if you will, in Greater China, to one of the budding ones in the metaverse, which I know is part of your bull case, Omar. I mean, when does that actually become reality to a really contribution portion of what Nike's future growth may look like?
Thanks for the question. I do agree with Adrian that China is a near-term risk, but I think there could be a big boom in China when they reopen, and the higher-end brands tend to win in that exuberant environment, as we saw in North America and Europe over the last 9 months. But I also think Nike has a huge opportunity globally to sell what are effectively virtual shoes. The blockchain technology really is a transformational technology for these types of products, because it can ensure the uniqueness and the rarity of these types of virtual products, frankly, in a way that you could never do with physical products. A physical rare a shoe on someone's foot could always be a fake. You can't be sure. With blockchain technology, if I have one of the 10 rarest XYZ shoes, with blockchain technology, I can prove that with absolute certainty online. And the other thing I would say is, the rare shoe collectors, which Brad, sounds like you might be one of those sneakerheads. A lot of those really rare shoes that they do collect, they never get worn because it ruins the value if you wear them. So in reality, they're kind of already like virtual shoes. And if you can bring that kind of rarity and uniqueness and cool factor to a much more mass audience at who knows what price point. Some of the most rare ones will be very expensive, and some of the more common ones I think will be less expensive. So people to use them with their avatars, it could become a very scalable, high revenue model with really high margins, obviously, because there's no physical cogs in those products.
Omar, rare air or not, I wear the shoes. I'm sorry. I don't know how people buy these shoes and just let them sit on the shelf to resell at some point. That's great, but for me and my house and myself, perhaps, I'm going to be wearing these rare airs out here. We got to leave the conversation there. Would love to have the conversation in person and have this reoccurring. Evercore ISI Senior Managing Director Omar Saad and Barclays Managing Director Adrian Yee. Thank you both.
As the Federal Reserve steps up its interest rate increases, American households will certainly feel the pinch in their pockets, on their mortgage statements, and their car payments. Here to discuss how consumers can navigate these tough conditions and maintain financial wellness is Ellevest CEO and co-founder Sallie Krawcheck. Sallie, it's good to see you. Certainly people are going to see this in all aspects of their financial health, right? The higher interest rates, and also perhaps in their willingness to invest, right? If they are seeing higher costs for things, maybe they want to allocate less to the markets. So I know this is a big question, right? But if you take that 10,000 foot view, what are you telling people about how to think about this environment?
Yes, well, Ellevest is a wealth tech platform built for women, really centered on women, built by women. And we're telling her, you know, this is the time to continue to make your recurring deposits into your investments if you're able to. This is the time not to panic and take the money out of your 401k or IRA if you're able to. And I'll be honest with you, the answer we typically get back from her is, I know you already told us. And so what we're seeing going through this difficult time is women are very concerned about inflation. Something like 77% of women rank it as their top concern. 90+% of boomer women very worried about recession, but they are staying the course on their investments, which is a reason women, when they invest, tend to outperform men, because they do tend to set a plan and stick with it.
Can you lay out for us as well, and I guess just kind of additive to what you were mentioning a moment ago, the reality of what we had seen early onset in the pandemic, and one of the ramifications later on was the she-cession and how employment had been impacted disproportionately for women in the pandemic, and then now coming out of it as we're trying to emerge from the pandemic, but there's still so much work to be done, where women are still trying to make the headway to not only have parity in wages, but also parity in the ability to invest and to kind of maintain some of those wealth building mechanisms.
Right, great question. And we wanted to get really a comprehensive and quantitative look at the financial health of women, the financial wellness of women. And we went out to see, are there any indices out there? Where's the deep research? And we couldn't find a comprehensive index, so we built one, the Ellevest Women's Financial Health Index. And you're right, when you look at its performance over the past, say, 5 years, women's financial health took a big hit during the pandemic because they lost jobs at a disproportionate rate. Improved coming out of the pandemic as they were returning to the workforce, but this year has been tough. Women, everybody's hurt by inflation. Women, because our wealth is only 32 cents to a white man's dollar, for women of color, it's pennies. So inflation hurts everybody, but hurts women more. So women were hit by that, which hurts the pocketbook immediately. But the other thing that women were hit by, which is an economic and financial issue, is the fall of Roe v. Wade, which might not affect them today, but the research is clear that it affects their pocketbook and keeps women in poverty, keeps women from achieving their full economic parity. So with the combination of that and consumer confidence falling and looking into recession, just 14% of women say they are financially prepared for a recession. It is worse for women financially by this measure, by the Ellevest Women's Financial Health Index, than it has been in the past 5 years, worse than the pandemic.
And as we were showing as well, the disconnect that we're seeing, or the different prioritization and concerns among different generations, is also quite interesting. While everybody, of course, is worried about inflation broadly and worried about the economy, Gen X and baby boomers are more worried about that, or they're listing it as one of their top worries, whereas younger women also put, more sort of social issues, if you will, on that list. Reproductive rights, obviously more of a personal issue, I guess, personally affecting issue for younger women. Housing prices, it makes sense, right, that younger women are more concerned about these issues.
I know. I was saying that the boomers are sort of, there are two ways to, or many ways to read the data, but one way to read it is 91% of boomers, their number one concern is inflation. And part of me says, oh, they're over it, the other stuff. And the other part of me says, no, they've actually lived inflation before and are the only generation of women who we surveyed who have, and so know really how tough it can be in the recession that can come after. But you're right. What was so interesting is these younger women, the Gen Z, the millennials, really knocked back over the fall of Roe v. Wade, really concerned about childcare representation, and in fact, wanting to hear from the companies they work at and the companies they buy from what their stance is on reproductive rights. And they're telling us the majority of millennial women are saying, I would consider leaving my company if our view on reproductive rights does not align. And certainly 2/3 are like, I wouldn't buy from someone if our view on reproductive rights doesn't align. So we see the difference. The one, though, that is across generations, a top 5 financial concern for women across generation, climate change. Climate change broke in the top 5, which I think we often don't think of it as a financial concern. But again, when these things go bad, they hit people in the pocketbook. And if you have less money, they hit you more.
Yeah. And if you are a younger woman as well, it could be an issue for your children, it's a long-term issue. One more thing I want to ask you about, and that is the disconnect between men and women and their number one financial priorities. Men, it's their retirement. Women, it's their family. Is that is that a problem? I mean, it's very sweet on the one hand, right? But on the other hand, is it sort of a problematic thing that you got to be focusing on your retirement?
Well, for sure. And recall, women live 6 to 8 years longer than the man in their life. 80%, by some measure, 80% of women die single. By another measure, when she outsources her money to him and it comes back to her, either because they get divorced or he passes away or something happens, 70% of women have a negative surprise. So my heart, women, their families, but please take care of yourself as well. Please take care of yourself as well. The other difference we saw with men and women, which I thought was really interesting, is men are quite a bit more concerned about stock market volatility and crypto volatility. And women are like, I don't have the time. I do not have the time.
Amen to both of those sentiments, right? Take care of yourself, and I don't have the time for that. Sally, thank you for being here. It's always great to catch up with you. LFS co-founder and CEO Sally Krawcheck. Appreciate your time.
Thank you.
Well, ESG investing has seen rapid growth in recent years as investors hope to capitalize on or incentivize companies to do better. But that meteoric growth now being checked by scrutiny over the broad standards of ESG and those concerns that the issue is increasingly being politicized. For more on this, let's bring in Steve Varley. He is EY Global Vice Chair of Sustainability. Steve, there has been a real turn, you could argue, in sentiment around ESG after 3 years of massive inflows coming into the funds. I'm curious how you're watching this from a top-down level. Obviously, there's a lot of storylines between what's playing out in Europe, how it's being politicized in the U.S. But as somebody who has really honed in on ESG, what do you make of the tide that's turning?
Well, firstly, Kiko, thanks for the invite to come along and talk about what has to be one of the biggest phenomenons in business over the last, maybe not 3 years, but at least 5 years. If you go back to the start of ESG, it's actually a term coined by the UN way back in 2006. So what we have now is a 3-letter acronym that's 16 years old. And I think we'd all agree is showing signs of being, well, maybe a terrible teenager. It's being misused in places, and it's also doing good in places. ESG, I think overall, I would say from my conversations, not just in the US, but Europe, Japan, China, is net good for business. It's created a great dialogue. But let's see where we go from here, because we're definitely at a crossroads.
And I know you have conversations with many companies on this particular issue. What's the sentiment right now around that?
I think it depends which of the letters you're talking about, the E, the S, or the G. I think in Europe, when you talk about ESG, you quickly go to E. And for many Europeans, E is synonymous with climate change. You come to the US, I think the E and the S both vie for leadership. There's so many social challenges here in the US, but also, especially with Biden and the IR Act, there's a lot more to be said now also on the environment and climate change.
The argument is, of course, that when you look at all three letters, ESG, who's actually being included in these funds, they don't necessarily reflect what people believe to be ESG. Should investors be looking at measuring impact from these funds? I mean, the question is, we don't even know how to define it and how to measure it.
Yeah, you're quite right in saying that. The standards are really immature here. If I compare them to financial standards, which is our EY heartland, we're quite some way away of having standards, I think, where people can, on the street, can do good comparisons. I think investors need to really work out what are they trying to do with their dollar. So if you really want to do well on climate change, well then looking at an ESG composite rating, where an organization has rolled up the numbers to say this is an A+ or a BB, that's probably not good enough. You need to go to the next level down. Really need to understand a lot more about where your dollar is.
What are you seeing in terms of inflows to the funds right now? I just pulled up a number from Bloomberg Intelligence that points to a pullback in the inflows that we've seen after a 3-year spike. Some would argue that, over the last 3 years, even though ESG has been going on for a while, that everybody just threw any company into ESG because the returns were so significant.
Yes, and I think now if we look back, we might start to speculate that some of those returns in ESG funds were actually driven by the technology stocks. And once we came out of the pandemic and the technology stocks came down a bit, so did the ESG funds. So on a global basis, I think there's a pause going on. There's nowhere near the level of influx we saw 2-3 years ago, where ESG was really being touted as a kind of miracle cure. You could do well financially and you could do good in the world. I think we're taking a pause on that definition now.
So what does the shakedown look like moving forward? You've obviously got regulation in Europe already in place. Here in the US, the SEC has put forward these proposals. The comment period's over, but as we wait for the SEC to say, yes, in fact, these are going to be the disclosure rules, you've got Republicans in some states, Democrats and others that are saying, we're just not going to be investing, at least in our pension funds, allow them to go through the ESG fund.
Sure. I would say actually in the US, this is a real lightning rod topic, isn't it? Very different to my view of what's happening in Europe, in Africa and the rest of the world. In the US, ESG has become far more politicized than I've seen happen anywhere else in the business world. We're definitely at a crossroads for ESG. I don't really know where it's going to go in the next 12 months. But let me go back to one of my starting points. ESG has been net good for business. It's created the right dialogue on the right issues. As all of us in business start to think about the externalities, what else do we affect? This is not just about profit. This is about the impact we have on other stakeholders, like the planet, like society. That's got to be a good thing.
You said you don't know where it's going to go moving forward. What does that mean from your operations? I mean, this is really the sole focus, at least when you think about being the vice chair of sustainability.
Well, we're watching very closely to see where Gary Gensler goes with this in the SEC. We submitted our comments back to that consultation. We think that a lot of the measures will be toned down. That'll make a real big difference, though, to the EU, where the EU is still going really strong to regulate this whole area and really expect a lot more from companies in their reporting. So one thing we do know for sure is there's going to be a division, I think, between where the US is and where the EU is. And Akiko, for big global companies, that's just going to make their life a lot harder as they have to now work in 2 different regimes.
What is that going to mean for EY?
Oh, well, for EY, I think we're going to have more clients who want more advice on what to do and how to navigate all of these things. And Akiko, let me say, we're always here to help.
It's going to be a lot more muddled, it sounds like, the landscape moving forward. No universal standard there, certainly not expected, at least in the short term. Steve Varley, EY Global Vice Chair of Sustainability. Good to have you in studio today.
Thank you.
Private oil drillers are hitting their limits as small producers in the Permian Basin start to pull back production. For more on what this means for oil production nationwide and prices, we want to bring in Deborah Byers, a Blue Tiger Advisors independent board member. Deborah, it's great to see you. So these private oil companies run about half of the drilling rigs in this region. How big of a deal is this for oil production here in the U.S.?
Well, I think you're definitely going to see a slowdown, but the thing to keep in mind is you're going to see some consolidation, which you've already started to see happen here in the last a couple of weeks. And the majors are going to have to really step in. And I noticed that there's been an uptick in stock performance. And I think that's showing some investor confidence that they have the balance sheet and ability to come back and put supply back in the market. We've been in a period where capital is very scarce. And that's what you're seeing with the private drillers. So capital's scarce for everybody, but in particular for the oil and gas industry, pressures around ESG, wanting to move money away from carbon intensive industries, and just, the environment we have right now with quantitative tightening by the Fed. I mean, those all plus inflation. We talk a lot about inflation for consumers, but it's really hitting the industry players, especially oil and gas on the service side. Costs are just rising tremendously. So that is going to put a lot of pressure on the private players. But, the larger independents, the larger international oil companies certainly have the balance sheet. And maybe this is a time for them to shift from 100% capital discipline, looking at yield, returning cash back to shareholders, to really starting to look at growth. If you look at in the horizon, whether we're in a recession or we're going to enter a recession, there's going to be a rebound. And when that happens, you're definitely going to see consumer demand coming back for travel and all the things that really drive demand. And prices will stay, I think the forward price, people are confident it will stay high. That's the time to maybe shift and think about investing for growth. So a little negative now, but I think if you're looking out 2-3 years, this may be the time to invest.
So what are your expectations? You mentioned consolidation there. How much of a contraction could we see in terms of the number of private drillers that are out there?
Well, look, I mean, some really smart management teams have put some good money to work. Some of what you're seeing is also the best plays may have played out. And so you're going to need, better technology, a deeper balance sheet to go after some of the other assets that are out there. So I think you're going to see a pretty significant slowdown, but I do think that this is a great opportunity for some of those private investors and private companies that have been, keeping the rigs working to really do an exit and sell to some of the majors.
No matter what things are like here, far worse overseas. Let's go to Europe, where you've got a fracking ban now has been lifted in Britain. They've also frozen energy prices for the winter around half what they would have been otherwise. Germany nationalizing one energy company. How bad, if you can put it in perspective, will that winter be? And how much does Vladimir Putin hold the cards there with a potential escalation in Ukraine?
Well, those are big questions. I wish I had all the answers. The price, support for the consumers is wonderful. And one of my favorite energy analysts on Twitter and Substack, Doomberg, he says you can't print molecules. You cannot print electrons. And so depending on how severe the winter is, we all know winter is going to be at least 2 or 3 months. And it's going to be, whether it's a harsh winter or whether it's just a normal winter, they're going to need heating fuel. They're going to need to be able to keep the lights on. So it is a very, very difficult situation there. They filled a supply as much as they could, but you look at some of the eye-popping costs, the cost of filling storage is just astronomical. Lifting the fracking ban, that's going to take a long time to play out. I know that the UK is trying to take some what I'll call pragmatic steps. But these things don't happen overnight. You know that you need 1 to 2 year lead times, and so that's not a short-term solution for this winter.
Well, Deborah, so it'll take 1 to 2 years then to restart some of these operations, you think? So it wouldn't really provide any relief here, at least it sounds like for 2 years.
Absolutely. I mean, you've heard a lot about the Great Berlin Gas Lift. I mean, I think it's really a heroic phrase, but the only supply that can really bring that, and they've already made huge efforts, is going to be LNG. And so you saw the U.S. LNG pivot from Asia to Europe to try to backstop the loss of supply from Russia. But there are limits to that, and then frankly, it's they're done. In terms of what can be locked up and what can be provided. So that 2022, that's going to play out however it's going to play out, and there could be a lot of pain. I think what we have to look to is what do we do to really get 2023 and to where it's not going to be a replay of 2022.
And so then when you look at ESG investing and people are like, look, we need heat for this winter. What is this doing to the investment landscape for ESG?
Well, there's a lot of really sort of negative discussion around this topic. And, the feeling that if you're making investments in oil and gas, somehow that detracts from the needed investments to accelerate the energy transition and renewables. And we have to keep in mind that in the last 10 years, the U.S. alone has invested $2.5 trillion in solar and renewables. Germany has invested, by 2025, I think is going to be investing close to, $500 billion. So that investment will continue. And so we need to be more positive. These things cannot happen overnight. I'd say these operating systems are hardware. It's not like a software operating system. We're going to push a button and all of a sudden tomorrow you've got a new system. It's going to take decades of investment. And, we need to be mindful that you can't simply turn the switch to going from all, fossil fuels where we're reliant 80% plus on, oil and gas to provide, the very substance of our modern economy, to relying on new technologies or even more mature technologies like renewables at 100%. So This is where you got to look at the timeline, and you've got to be kind of practical and make sure that we can keep the lights on for everybody, and we can continue to, have iPhones and smartphones and computers.
California regulators are looking to reform its rooftop incentive program by raising fees on owners of rooftop solar systems. Well, joining us now to discuss the implications and the future of the state's power grid is Mary Powell, Sunrun's CEO. Good to have you on, Mary. So you've called this proposed solar fee that connects rooftop solar systems to California's power grid a perilous path. What concerns you most about this?
Well, I mean, everything concerns me about it. It's just, we need to be working really hard now on creating the grid of the future, which is the grid that's cleaner, more affordable, and more accessible to all. And fundamentally, that is what we're doing by bringing the ability for customers to have greater energy independence and to be able to create their own energy, store it, and use it when it's most affordable and make sense for the grid. And in fact, we really helped out in a significant way. Our 17,000 customers produced a gigawatt of energy for the California grid during the heat wave. So it's perilous in the sense that there's a huge lost opportunity by not leaning in harder to this amazing resource for the grid of the future. But it's perilous also in the context of fundamentally, because we see so many customers wanting to achieve greater energy independence. If the utilities got their way and doubled the price of solar for customers, they are naturally going to look for ways to defect from the grid. They're going to look at ways to just not be connected, produce their own energy, use it, and not provide it back to the grid when it's most affordable for the grid.
So as we look at some of these companies, I mean, you have Southern California Edison, you have Pacific Gas and Electric and San Diego Gas and Electric. Now, they're saying that this fee is about equity. They're saying that because of the incentives, the savings that solar customers get means that they're not paying their fair share when it comes to contributing to the grid. What are your thoughts on that?
Well, my thoughts are that fundamentally it's inaccurate because fundamentally this was all based on what is called a look back study. So much of it was looking back at candidly, how it was 5 years ago, how it was a number of years ago. Right now, across the country, the industry is providing solar to customers that are in those brackets that most need it. They most need affordability. And Sunrun has been a leader in providing this alternative to multifamily housing to, lower income customers all across the country and all across the state of California. So that's one area where looking back gave an erroneous data point. The other thing is, again, it never anticipated events like we just went through last week in California, where prices hit historic highs, where every bit of energy that our 17,000 customers were providing back to the grid was making the grid more affordable during those days than any other market energy available to the utilities. So fundamentally, what I've been saying is there is so much we can do and benefit from by radically collaborating and creating the grid of the future and not looking back, but looking forward to the amazing value that can be created by having this much greater distributed, resilient, affordable grid for all.
So then, if you had the ear of Gavin Newsom, then what would you suggest as a better alternative to the fee? What is a better way to still achieve this, especially since California is trying to be fully green with its grid by 2045?
Well, we've been really clear. Again, we see just tremendous opportunity. I was a utility CEO for over 10 years, and it's proven that it can work, that we can radically collaborate. So my message is always, hey, let's give customers what they want. They want more energy independence. They want more resilience. They don't want to be asked to not use energy during critical times, right? They want to power their vehicles. So let's radically collaborate and create the more affordable grid of the future. It can be done. It's proven in other areas and in other states. So let's just do it. That is always my message. Let's do it. We've got to be customer obsessed. We've got to meet customers where they are and provide them with affordable, resilient options for the future. So that has been our focus. We've been a leader in, again, leveraging these assets in a way that can make the grid more affordable. And in fact, in Puerto Rico, as we all know, with, Hurricane Fiona, Puerto Ricans are really suffering right now. The grid immediately failed. And again, it's the 100-plus-year-old way of thinking about delivering energy. So it's no surprise that it would fail during significant climatic events. But our systems have been powering customers through this entire event. Now, thankfully, because so many in our industry have been busy in Puerto Rico for years, you have 50,000 customers that have been able to power through this kind of climatic event. So again, there are examples over and over again where we can make not just a more affordable energy future for the customers we're serving, but for all the customers of the grid by leaning into innovation, leaning into these new technologies, and then leveraging them along with electric vehicles and the capability we're going to have with electric vehicles to also power the grid from customers' homes. So there's an exciting future ahead for us if we all just radically collaborate and work towards that and not think about steps that are steps backwards.
So then just very quickly, as we're running out of time here, what is it going to take then? What are the biggest challenges in really bringing the price and accessibility of solar down further faster? Because some people don't have it in their area, or they can't afford large upfront costs, or don't meet the credit requirements. What are the biggest challenges that you see?
Well, one of the most powerful opportunities, again, we've been doing a lot of work in the multifamily space. So again, it is bringing it to those communities that you're talking about. And again, that is the tremendous opportunity that's right in front of us to do that. And with utility rates skyrocketing, with customers now, with, again, the recent moves by the Fed, I mean, customers are going to more and more be looking for affordable options, not just affordable, but stability, resilience. So again, the solutions are there. We just need to work faster, to accelerate them. And again, even in California, the regulators have wanted a tripling of solar energy provided to customers to meet their clean energy goals. So doubling the price of solar, if the utilities got their way, would make no sense in the context of achieving all of the clean energy goals we have ahead of us.
In this episode of Influencers, SEC Chair Gary Gensler.
I come with a deeply markets background. I really believe in markets. I think markets are a critical part of our economy, but regulated markets. The events in Eastern Europe just, sort of highlight once again the importance of cyber resiliency. If you're raising money from the public, and the public's anticipating some profit based on the efforts of those folks raising the money, that comes within the definitions of a security and the securities laws, and it's kind of straightforward.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Gary Gensler, Chair of the Securities and Exchange Commission. Gary Gensler was sworn into office as the 33rd chair last April, and in a little under a year in office, he's pushed the SEC right into the middle of the conversation surrounding cryptocurrency, meme stocks, and other issues as well. Chair Gensler, thanks so much for joining us.
Andy, it's so good to be with you and your viewers.
Thank you. Whole lot to get to, but I want to start with the news in Ukraine. Especially the reaction from the business community. The New York Stock Exchange recently moved to temporarily halt trading for Russia-based companies. Have you been monitoring that, and should it be a permanent ban?
So just stepping back from any one circumstance, the staff of the SEC are monitoring markets as we do through these times, throughout the whole time that I've been at the agency. It's not just about the geopolitical events in Eastern Europe. But yes, they're monitoring. We're staying close to those events. We're talking to our colleagues at the U.S. Department of Treasury and across the financial regulatory complex, the Federal Reserve, and other regulators, as well as globally to regulators in the banking and the securities fields across the globe, just to stay close and monitoring events with these really unusual events out of Eastern Europe and war in Ukraine.
Do you feel you have enough transparency into U.S. corporate exposure to Russian assets and the Russian economy? Do you have worries about hidden U.S. connections as the Russian economy may be headed for a recession or worse?
Well, Andy, I'm going to stick to our remit at the Securities and Exchange Commission, which is about overseeing, yes, $100+ trillion capital markets and ensuring that they're fair and orderly, efficient, and in these unusual times, we're monitoring for that. But I do feel that we've had good dialogue with major market participants in the fund area, in the broker-dealer area, the exchanges, the clearinghouses, and at least for these handful of days so far, the market functions have been operating relatively well. But what comes tomorrow, what comes in the future, we're monitoring against events as they come.
I understand it's not straight ahead into your remit, but obviously, as you suggest yourself, there are implications potentially, and potential even systemic risks to the global macro system. One last question here, Chair Gensler, about that though. Are there actions the SEC is taking or considering taking in response to what's going on in Ukraine and Russia?
Again, we're staying alert and monitoring. We're staying close with the rest of the Financial Stability Oversight Council agencies and our colleagues around the globe. If you look at funds under management, the total multiples of tens of trillions of dollars of assets under management here in the US, only a very small percentage, measured well below 1%. In fact, only a fraction of 1% are invested in Russian securities or ADRs traded overseas and things like that. So yes, we're going to continue to monitor, and especially stay alert for any cyber risks or any other market functioning risks. But I think that's what our role is, and then to ensure for our three-part mission: investor protection, capital formation, and then that in the middle, the fair, orderly, and efficient markets.
Okay, sounds good. Let me ask you about crypto, which is part of your purview, I guess, increasingly, and something you've been considering a lot lately. I know last time you were on with Yahoo Finance, the prospects for a spot Bitcoin ETF came up, and you had a lot of questions about how investor protection would work there. Have your concerns been alleviated? Is approval coming, do you think?
Look, we at the SEC are technology neutral, but we're anything but public policy neutral. And so this investment class, a little less than $2 trillion of assets of valuation in cryptocurrencies, if you wish, or crypto tokens, Bitcoin and all the other tokens, is a highly investable asset at this point in time. Many tens of millions of people around the globe have chosen to put some of their savings into this space. And so it's every bit as important to have investor protection for crypto exchanges, for the lending platforms where people are transacting, buying and selling crypto tokens, and have appropriate disclosure about the tokens themselves and protect the public from fraud and manipulation. And that's really what we're looking at. And yes, as you said, the SEC has a role to play. Other agencies do as well, but the SEC has a role to play because Congress painted with a broad brush. And if you're raising money from the public, and the public's anticipating some profit based on the efforts of those folks raising the money, that comes within the definitions of a security and the securities laws. And it's kind of straightforward. Congress saw that was an opportunity to mislead the public, to sell a sham transaction, that the public could make a decision, the basic bargain. The public gets to decide on their investments as long as those promoters raising money are giving full and fair disclosure. And there's basic laws about protecting against fraud, in essence, lies about what's going on.
Right, and sort of following up there, you also told us that you hope this year crypto trading exchanges would come
within the public policy perimeter. Look, we had just a couple of weeks ago working with one of the larger lending platforms, where a platform was taking money in. It's public. It was BlockFi, 600,000 or so retail accounts and institutional accounts, people putting their crypto assets at risk with BlockFi. BlockFi then saying, we'll give you a return on an account. We're trying to bring those parties in. In that case, that was they were not following the securities laws, investment company laws, and the Securities Act laws.
So does that mean, though, that the exchanges will come under SEC regulation, strictly speaking, this year?
Just do a little bit of probabilities here. I'm sort of a math guy. I was when I was a kid. My identical twin brother and I, that's kind of who we were and everything. But these platforms often have not just dozens, but hundreds or thousands of tokens on their platforms. And these tokens, back to the securities laws, many of them, without prejudging any one of them, many of them may well be securities. Probabilities are that these platforms, there's 10 or 15 large platforms, these crypto trading platforms, have 75 to 5,000 tokens on them. Probabilities are they have securities on them. Our laws are straightforward. You're supposed to register as an exchange where people are buying and selling those securities. And yes, many tokens, many crypto tokens have been found in the past to be securities. And I'm not trying to prejudge any one token, but probability weighted, there are many of these tokens on these platforms.
Oh, so what's the probability then of you waving a wand and saying, okay, you guys are now
I don't think the law is clear.
Yeah.
The law is clear. It's not about waving a wand. Congress
Okay.
spoke about this in 1934. They amended these laws multiple times since over 9 decades. And a platform that has securities on it is an exchange. It's a question whether they're registered or they're operating outside of the law, and I'll leave it at that.
Are you concerned, Chair Gensler, about the decrease in the number of public companies in the U.S.? And I know there's arguments about how extreme that decrease is. Nonetheless, there are fewer today than there were 20 years ago. And then the fact that private companies grow into deca unicorns and are great investments, perhaps, but they're unavailable to ordinary investors. They're only available to the people on Sand Hill Road, and how that might be exacerbating inequality in this country.
So I think that we have vibrant capital markets, this $100+ trillion capital markets that are kind of the envy of the world, frankly. I think anyone who's honored to be in the role I'm in, as you said, Andy, the 33rd chair, and there'll be others, for decades to come in this great agency. What central to our roles as chairs, past chairs and future chairs, is to ensure that we continue to be the envy of the world, that we have the leading capital markets, and we have a vibrant public capital markets and vibrant private markets. We are taking up a lot of projects here at the SEC about those private markets to bring greater transparency, greater efficiency. If we have more efficiency, and yes, competition in the middle, that's better for those private companies, whether they're small startups or the unicorns, and it's better for the investors. So we're trying to drive efficiency in the middle. We're also trying to drive for greater transparency, particularly as it relates to financial stability risk emanating maybe out of hedge funds and the like. So we've got a lot of projects driving competition and transparency, but part of our markets is both public markets and private markets.
Speaking of the envy of the world, what is the future of Chinese stocks listing in the United States? Does the SEC have a role or a position in this situation, one way or the other?
So we do. So we're blessed in the U.S. again with such robust and strong capital markets that between 1,000 and 1,500 foreign companies actually list their shares here in the U.S. And it's not just China companies, but a lot of Europeans, Asian, South American, African, Australian companies. It's just from all around the globe. But there's some basic understandings that if you want to list in the US, you need to comply with our investor protection rules. And one of the key things that came out 20 years ago, one of the key things was that if you want to be issuing and raising money in the US, that you have to be not only audited, that the company has to be audited, but the auditors have to be open to inspection. Kind of simple idea, audit the auditors. And Paul Sarbanes, a Maryland senator who I had the honor to work with, Chair Sarbanes, passed that law 20 years ago. Bipartisan, with Republicans on the Hill, with Mike Oxley, and with President Bush. 20 years later, 50+ jurisdictions around the globe have allowed U.S. entity called the Public Company Accounting Oversight Board to audit the auditors, but China has not. So Congress weighed in again 2 years ago, or a year and a half ago, and said, no, that's not right. And they put a clock that had to happen. So where are we today? I think it's really, we've had some good discussions with our counterparts from China. The Public Company Accounting Oversight Board has had some good discussions, but it's really up to the officials in China. If they allow the auditing firms in Beijing and Shanghai and elsewhere to be inspected, and that their work papers are actually shared, and not with a lot of redactions, but actually shared, and their auditors actually allow themselves to be, give interviews and testimony, like 50 other countries have done,
right,
then there's a path forward. Otherwise, Congress has spoken about 250 Chinese companies in this 3-year clock, potentially as early as 2024, would have to suspend trading here.
Another proposal in the works is specifically in response to last year's meme stock craze. I believe it would shorten the amount of time it takes to clear trades. How would last year have played out differently had that rule been in place?
So the events around the meme stops, or as you know, GameStop, led to a review by the SEC, and the staff came up with 4 areas we should take a look at. And we have, in 2 of those areas, put out proposals. 2, we've working on some more. So one is what you talked about, is the basic plumbing, shortening how long it takes for money to move and stock to move. It's called settlement period, from 2 days to 1 day. We've also done something around transparency around short selling and made a proposal last week around that as well. Shortening the settlement cycle lowers the risk in the system. As the old saying goes, time is money. Right now, if you do a trade on a Monday, you don't move the money or the stock until Wednesday. You shorten that to Tuesday, less risk. In the middle of that January, the fateful January around the GameStop events, a number of online brokers and brokerage apps said, we can't let retail public access the market. And that's just, that access to the market is so fundamental that part of the issue was the settlement cycle thing, but it's not the only thing. And as I say, we have 4 projects. We've proposed 2. The other 2, looking at really the equity market structure itself and payment for order flow and the dark pools of capital that are flowing without transparency. That's a major project that I'm hoping staff will make recommendations and we'll move forward. And lastly was this thing called gamification, or what we've come to call digital engagement practices.
The Wall Street Journal has reported the SEC is looking in recent sales by Tesla CEO Elon Musk and his brother Kimball whether they violated insider trading rules. I know you can't comment on a possible.
I'm glad you said that for your viewers.
Yep.
I'm not sure where you're headed.
I'm going somewhere. Chair Gensler.
All right.
I know you can't comment.
I'm not going to be able to comment
on a possible investigation, but have you talked about the need for stronger insider trading rules generally, and how big an issue has this been in your first year? Is insider trading a problem that you're focusing on?
It is. It is from our enforcement side, our terrific enforcement efforts headed up by Director Grewal, Sanjay Wadhwa, the whole team, just terrific team. But it's also from the policy side. We've even done something about insiders. When can corporate executives sell their shares? And there was something put in place about 20 years ago, which was called a safe harbor, if you might. And we came on board and thought there's too many gaps in this area, that in senior management might be trading stock when they're in receipt of material non-public information. And we put this proposal out in, I think it was December or so, about these so-called 10b5-1 plans. And so both from really vigorous enforcement, but also from the policy side about insiders, we're taking it up in both ways. And I think it's a really important part, because it comes down to trust in our capital markets and trust that there's a level playing field, that when you're in the markets that somebody doesn't have an information advantage from material non-public information.
What are your feelings about the debate on Capitol Hill right now about lawmakers being able to trade stocks? My understanding is that SEC employees have pretty tight restrictions, with some stocks being off limits and trades needing to be pre-approved. Is that fair? I mean, should it be the same for everyone in all different branches of the government?
Look, I'm going to leave that, as you can imagine, to Congress to think through. We're certainly we're willing and able to give them technical assistance on that. The Stock Act that was passed about 10 years ago by Congress and set certain reporting obligations on members of Congress, and also certain limitations as well. We as an agency actually have a role to play in that Stock Act. And that's ongoing discussions, I know, up on Capitol Hill, and wherever they come out, we stand ready to help implement our part of that if they change those laws.
And finally, Chair Gensler, other recent SEC chairs, including Jay Clayton and Mary Jo White, came to the job from more of a legal background. You worked as a banker at Goldman once upon a time ago. How has that background and the insight you garnered there changed how you approach these issues in running the commission? Is it any different?
Well, I'm honored to be in this job. I mean, the then President-elect Biden asked me to do it. It's one of the greatest honors of my life. You know, right up there with my 3 daughters, I guess, but my 3 daughters maybe higher honor, and the wonderful woman I was married to. I would say this: I'm the 5th chair of those 33 that is a non-lawyer. You know, from the first chair, Joe Kennedy, the President Kennedy's father, Arthur Levitt, William Donaldson, some really fantastic chairs. Look, we all come with different backgrounds, different perspectives, different experiences. I come with a deeply markets background. I really believe in markets. I think markets are a critical part of our economy, but regulated markets. I think that the laws put in place in the 1930s, in this 8-9 decade period of the SECs, that what Franklin Delano Roosevelt laid out, and many really wonderful people at the SEC and on Capitol Hill too, have augmented, is we've enhanced economic growth. Because when you enhance trust, this basic concept that if investors get to decide, but they get full and fair disclosure, and we protecting them against fraud, that the exchanges have to register, but there's a basic rules of investor protection, and this 3-part mission to facilitate capital formation, investors, and the efficient markets in the middle. I think that's a really great bargain. Now, for me, I've also had the great honor to chair another agency. So along with Mary Shapiro, Mary and I are 2 people that have chaired both the Commodity Futures Trading Commission and the SEC. So it's great to talk to my former chairs. There's 8, I think, of 8 or 9 now that are still alive, and I call them on a regular basis. I check in. And there's just a terrific group of commissioners, my fellow commissioners, Allison Lee, Hester Peirce, and Caroline Crenshaw. And we all bring a little bit different skills and perspective, and we bring it together.
Gary Gensler, Chair of the Securities and Exchange Commission, thank you so much for joining us.
Thank you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Or whether that's by an Amazon and Thursday Night Football, or whether that's even by an Apple, which we'll talk about a little bit later on. I think there's so much opportunity for the annexation of streaming to sports. It's really just a matter of how much all of these brands in the streaming space are willing to pony up for that new customer acquisition, and hoping that they'll consume some of the other content that they're paying millions, if not billions of dollars to produce over time too.
Yes, indeedy.
Yeah. Guys, coming up, which housing markets are holding up the best, and I guess on the other side of that, the worst? We'll break down that with UBS home builders analysts coming up next. Welcome back to Yahoo Finance on this Friday. I'm Brad Smith alongside Julie Hyman. Brian Sazi is on assignment. We'll be back next week, though. About 30 minutes into the trading day here on this Friday, let's check in on the markets. Not so yay there. In fact, it's a nay. Now, Dow Jones Industrial Average has slipped lower, and it is down by about 1.4% at this point in time, 428 points in negative territory. The S&P 500, you're also seeing that down 1.8%, and the Nasdaq Composite also lower by 2% for the tech-heavy average. We're going to continue to track that very closely, and coming up in this hour as well, Qualcomm revving up its partnerships, announcing a deal with Mercedes-Benz for its upcoming vehicles. We'll be joined by an executive from the company. And one of the largest U.S. crypto exchanges getting a major leadership change. We talk with Dave Ripley, who has been tapped as the newest CEO of Kraken. And Yahoo Finance's Brian Sazi caught up with Slack's chief product officer and talked all things return to work. You do not want to miss that. But first, let's get on over to Julie Hyman at the Yahoo Finance Interactive.
Hello there. I want to start with oil prices, actually, because the move that we are seeing today is fairly remarkable in oil here. Right now, down almost 6% for WTI, below $80 a barrel. So that's the first time we've seen going below that threshold in quite some time. Here you have the 3-month chart for crude oil prices. And this is really feeding over into what we are seeing in terms of the groups within the S&P 500 as well, as I'm trying to figure out how to get us to the sectors here. I'm going the wrong direction, apparently. Here we go. As we go down to the sectors, we are seeing energy stocks really under pressure here. Energy stocks down about 6% right now. They were down as much as 6.4% as a group earlier in the session. So this, again, I really want to put a fine point on this. This is the best performing group of the year. We have been seeing oil prices slide. Gasoline at the pump has slid, as we've talked about before, for 100 straight days before pausing in that slide. But if this is any indication for what we are seeing with oil prices and energy stocks, we could continue to see a cap on gasoline prices by extension. Here's the year-to-date chart. It's still up 28% for the year. So really important move here that we are seeing today in energy prices, really a breakdown in these stocks. Consumer discretionary also under pressure today. That's the year-to-date. It's exactly the inverse, down 28% and still down today. And then real quick check on material stocks, down 25% year to date and under pressure once again today. And let's talk more about that group, materials and home builders for that matter, because we've been talking a lot about the recent housing numbers and the softness that we've been seeing as we have seen sharply higher mortgage rates. For more on all of this, let's bring in John Lovallo, UBS home building products analyst. John, thanks for being here. We heard from some of the home builders recently. We've been getting home builder confidence numbers that are not great here. There are so many constraints on these companies' business. Let's start with mortgage rates here and how you view the trajectory here. Do we continue to see pain all the way up as mortgage rates continue to go higher, or at some point do consumers make an adjustment?
It's a great question, and thanks for having me. I would say that historically, when we have seen these sort of sharp moves in rates, there's always an adjustment period. It takes time for consumers to realize that, hey, we're not at that 3.25% rate anymore. We're closer to 6.25%. But let's take a step back and see what we can do to make things work. And there's a lot of levers that the home buyer can pull. You think about the first-time home buyer in general. I mean, you can move to a smaller footprint, further away from city centers. There's a huge in-migration trend in the U.S. where folks are moving into the Sun Belt, into lower-cost areas. There's a massive wealth transfer that's going on in the U.S. $68 trillion being channeled from baby boomers to millennials and Gen X. And there's a lot of student debt relief going on, and even more in the pipe. There's been $25 billion so far. So things are tough when rates move very quickly. There will be a reset period, and there are a lot of levers that can be pulled.
Okay, and so there's a lot to break down even within that. So I guess starting things off with where home buyers do have any type of leverage, because for the builders, the confidence, that has sputtered. We've seen that slip for consecutive months. Where, I guess, are home builders going to start to see some of their confidence return? And that seems like some of that, or much of it, is directly hinging on some of the supply chain concerns also alleviating themselves.
Yeah, really good question. I mean, there's a lot going on in the market right now. Consumer demand has certainly moderated. That's to be expected given what we just talked about. But there are lots of supply constraints still in the market. The fact that builders getting land even zoned and entitled has taken a tremendous amount of time, much more than it would historically. So what does it take to get builders confident again? It's a good question. I think that, one, we're starting to see some easing in the supply chain on the margin. So that will certainly help. And the moderation in demand is going to also help that. But I think what's interesting on the consumer standpoint is that we've seen over the summer months, and this was actually reported by both KB and Lennar yesterday that reported, that we've seen improvement, at least sequentially, through the summer. And the summer is historically a slower time. So this is really unseasonal, the strength that we've been seeing. Now, it's not great, but we are seeing a little bit of signs of improvement, which suggests perhaps that the consumer is getting a little bit more comfortable with rates.
John, we talked earlier in the week to the president of the National Association of Home Builders, and granted, his realm is much more political than yours, but he did interestingly point the finger at policy in part as being to blame for some of the weakness in the housing market in terms of zoning not being more favorable, for example, and also, of course, the effect that the Fed has had on interest rates. How do you view those issues and whether anything's going to change on those fronts?
That's a tough one.
Yeah.
I think that there are certainly some restraints that have been put into the market in terms of regulation, whether that's on the land side or just zoning in general. And that's a challenge across the board. I mean, I think on the margin, maybe it's gotten a little bit worse. But I think it's always been somewhat of a challenge. In terms of rates, I mean, Powell's in a tough spot where we need to get inflation down, and I think that he and his team are doing the best to kind of manage that. Where rates go from here, it's very difficult for us to tell. But at the end of the day, people need homes, and there's still homes that are sold. And I think that will be good for the home builders over time once we can kind of get a little bit more comfortable with the current environment.
That's really interesting because previously there was this advice to prospective home buyers to wait for this pivot in Fed policy. But now that we know that the pivot has essentially paused in any type of fodder for conversation, where are we going to see home builders home buyers rather? Should we see them? Should we expect to see them kind of rush in to try and take advantage while rates are lower before they get even worse?
Perhaps. I think right now, though, we're still in that adjustment period where we saw about 140 basis points of rise, since late summer. It's really been sort of unprecedented times. So I think there is a reset period that's going to need to happen. Now, will folks rush in and try to, beat the next leg up? I don't know that anyone knows the answer to that because no one really knows the direction of where rates are going. And I think that's a big challenge for not only home buyers, but for investors in the stock is we don't know where rates are going. So it's really tough to figure out what you're underwriting when you're buying, agreeing to buy a home or buying the stocks.
John Lovallo, UBS Home Builders Building Products Analyst. Thanks so much for the time this morning. Appreciate it.
Thanks for having me.
Definitely. Everyone, let's take a look at a trending ticker right now. Take a look at shares of PINS, pins, down 4% right now after reports from Deal Reporter saying the company's largest investor, Elliott Investment, may push for a sale. Elliott's involvement with Pinterest was reported back in July by the Wall Street Journal, which said at the time that the firm had built a stake of over 9% in the company here, Julie. This has been really interesting to track in terms of what Elliott's ultimate goals were with that stake that they had built up in Pinterest.
Yeah, what's interesting is that the stock is not going up, right? We had a little bit of a spike earlier in the session when this first started percolating out there. This was reported by Deal Reporter, which is behind a paywall. So then it sort of trickles through, right, the system and the chatter among traders. But you would think if Elliott's pushing for a sale, that Pinterest would be higher. So the fact that it's not maybe throws a little bit of skepticism into the equation or questions about if they were going to sell themselves, who would buy them?
It is, and it's a question of, as well, what category still Pinterest wants to play in. it's not clear. The company was trying to step away from being annexed to the other social media companies at the time when it went public. It's still tried to be, and largely has been, kind of this inspirational platform for finding out new things that you might be interested in, and whether that's DIY projects or whether that's just finding new recipes or just finding inspiration for everything from your next outfit that you want to wear all the way to the way to kind of propagate a new plant. And so all of that has now gone increasingly to some of the other social media platforms that Pinterest didn't want to be annexed to. So it's a larger question of, for whoever would be that acquisitive company, the company that would come in and swoop in and ultimately kind of put them under their umbrella, what vision they have for growing out Pinterest and that average revenue per user on the platform too.
Right. Lots of good questions about all of this. And like, would it be someone in e-commerce who could link up and monetize all of those different, I mean, they've done some of that already, right? A lot of the Pinterest stuff has links, but I don't know.
We'll have to continue to watch shares as we move on throughout the day. Yeah. Coming up, Brian Sozzi spoke with Slack's chief product officer at the Dreamforce conference. We're going to share that interview on the other side of this short break.
Let's get down to business now and take a look at some of the other headlines that we're watching. Boeing set to pay $200 million to settle charges by the Securities and Exchange Commission that Boeing misled investors by making false statements about the 737 MAX's safety risks while under the leadership of past CEO Dennis Muilenburg. SEC Chairman Gary Gensler saying in times of crisis, it's especially important that public companies provide fair, truthful disclosures to the public, and Muilenburg failed in the most basic obligation, Gensler said. Muilenburg will pay the securities regulator $1 million to settle the agency's claims. Tesla recalling over 1 million vehicles over window finger pinching concerns. Tesla says the automatic window reversal system may not react correctly after detecting obstructions, according to safety documents posted by U.S. safety regulators, and that is a violation of federal safety standards. Tesla discovered the issue in August. It will roll out an update to fix the problem. The company also filing a countersuit, meanwhile, against the California Civil Rights Department after that agency accused it of fostering racial bias in its Fremont factory. Tesla says the agency did not give adequate notice or earnest engagement in efforts to resolve violations. And it's official, Apple Music is replacing Pepsi as the primary sponsor of the National Football League's Super Bowl halftime show. It'll begin with Super Bowl 57 in February. The Super Bowl, usually the most watched TV event of the year, with over 120 million viewers tuning into this year's show. Though terms of the deal have not been released, it's expected to become a key platform for Apple, which has been a key player in music since it introduced the iPad in 2001. Apple's also among a number of companies bidding for the NFL Sunday Ticket. DirecTV's deal expires at the end of this season, and this is reportedly part of the ongoing negotiations between Apple and the NFL that it is getting this sponsorship deal for the halftime show. Coming up, Qualcomm is revving up its investment in the automotive space. We'll speak with the company's automotive senior vice president next.
One of the largest U.S. crypto exchanges is getting a major leadership change amid the current meltdown. Kraken's CEO, Jesse Powell, stepping up to the chair and that of the exchange's board. In that role, he's going to oversee product and dip his toes into advocacy work after finding himself in the hot seat due to insensitive comments and a poor corporate culture. Joining us now is Kraken's COO, Dave Ripley. He's been tapped to succeed Powell as CEO. Good to have you here with us today. First and foremost, the leadership changes coming after a time where corporate culture has certainly taken a hit. So with all of this in mind, what is the company and the executive team trying to signal to the team, the employee base, even amid so much of the challenges that the broader macroeconomic environment have presented?
Yeah, well, thanks for having me on here. I think a couple things there you wanted to touch on. So culture and then the broader environment. So first of all, on culture, Kraken's culture is thriving. It's amazing. We just recently, of course, did some great work articulating and codifying our culture, and we released that publicly. And it's been a resounding success for us. On the heels of that, we launched our annual engagement survey, and across the board, we're above industry rankings on almost every category to a considerable degree. So just a fantastic set of team members, Krakenites as we affectionately call them. So culture is in a fantastic place, and we wouldn't make this move if that wasn't the case. On the broader market, for sure, absolutely. It's probably a crypto bear market here, but this isn't our first rodeo. I've personally been through 3 bear market cycles in my time in crypto. And this one more than ever is an opportunity for us. We've been doing a great job of adding new talent to the team as the recruiting environment gets a little bit more amenable to opens up a bit more, and have been focused on scaling the business, scaling the product operations, and all these types of things that we have an opportunity to do while the market plateaus here. So we're really excited about the opportunity to catch our breath, to really fortify the business and get ready for some significant growth to come.
Dave, I'm just curious. I know you've been around with Kraken for a while, and so between this leadership shift, is there any meaningful change the company will see that you want to speak to? I mean, I know obviously the company has been talking about doing something like an IPO for years. And
sure. Yeah. So great questions there. So, first and foremost, I'll just hit on the similarities. Kraken is incredibly mission driven. Our mission is going to remain steadfast. Our values and our culture, they'll remain unchanged. And this is the constant. But you're absolutely right. Look, Kraken is, since the time I joined, we were 50 people, and now we're over 3,000. So, as we look forward to grow, we will have to change and adapt, and we'll have to scale the business and, look to operate differently, ideally keep some of that innovative and entrepreneurial potential. But, frankly, scale and meet the challenges of a larger organization. So that's undoubtedly going to be the case. And then with regard to, IPO and fundraising, for sure. So we, are always, kind of top of mind with regard to our capital structure and where we sit. We have a strong financial position, balance sheet right now. We haven't actually tapped capital markets and fundraising significantly in Kraken's past relative to our peers, if you will. But it's absolutely something out there that we could, look to fundraise in the future. And, whether that be private or public is, something that would be TBD.
Dave, I got to say, there's a lot going on at Kraken. I mean, we talked about the cultural issues a little bit. You guys are reportedly under investigation from the Treasury's Department of Office of Foreign Assets Control over potential sanctions violations. The former CEO told people to leave the company if they didn't like the culture of the company, if they didn't like what he had to say. And a lot of people didn't like what he had to say. Did you guys have an exodus of people? Are you now, as you're rebuilding and changing the culture, are you trying to hire a lot of new people if those people left to replace them? From the outside looking in, feels like there's a lot of turmoil there.
Yeah. Like I said, could not be more inaccurate on that last piece there. So, I'm not too sure how else a company would want to operate other than to clearly articulate their culture and ensure that people that are part of the company are actually happy there and want to be part of the culture. And that's exactly what we did. I'm nearly certain in the absolute dozens of companies that I've worked with, public companies, Fortune 500 companies that, those with the, kind of like the strongest mission and culture are the most successful. And that, that's definitely Kraken. And so, upon articulating our culture, we did actually take the step to say like, hey, if anyone here isn't on board with this, we're happy to help you find your next opportunity. And
so did people
that's
leave?
What we did. Yeah, it was about a fraction of a percent. So a little less than a percent of the total. So it was something just under 30 people, and we have about 3,300 total in the company.
Yeah, Dave, turning towards the staking side of your business, which has gotten a lot of attention since Ethereum just sort of transitioned to proof of stake and it's created this whole staking industry. I wanted to ask, have you seen any significant changes with your staking business since the Ethereum merge. I've seen a note from JP Morgan that sort of pointed out that Ethereum staking hasn't really grown as much.
Welcome to Yahoo Finance on this Friday afternoon. I'm Shauna Smith along with Dave Briggs and Rochelle Akufo. Let's get you up to speed on today's market action, and it certainly is ugly here. Dow, S&P, Nasdaq all firmly in the red, right around the lows of the sessions here as we enter the final hour of trading. You can see the Dow now below 30,000. Looking at a 5-day chart, clearly it has been a brutal week for the markets over the past 5 days. Dow now off just around 5% on an intraday basis. The Nasdaq falling below 11,000 as we've seen a lot of these larger cap tech giants here getting hit as we've seen rising rates. Obviously, the strong dollar here weighing on the broader markets. S&P falling well below 3,700, now on track for 3,600. We had Goldman coming out today lowering their year-end target on the S&P. So certainly some fear in the market action today. And really we could say that about the market action for the week. Over the past 5 days, you can see the S&P off just over 5.5%. I want to pull up the VIX, the fear gauge index, certainly very important here to keep an eye on. Spiking above 30 here really shows some of the fear out there in the market right now. Also the 10-year yield pulling back just a bit, now off just around 2 basis points at 369. It did break top 3.8 earlier in the session today. Let's take a look at some of the sector action here because again, we are seeing red across the board now on an intraday basis. You're looking at energy off just over 7%, the XLE off 7%. Weakness in energy is a big story here in today's market. Consumer discretionary materials among the worst performers for the day. And then taking a look at the past 5 days, a very similar picture here. All 11 of the S&P sectors in the red. Energy by far the laggard, off nearly 11%. Consumer discretionary real estate here among the biggest laggards. Consumer staples, I guess you can say it's the best performer of the bunch. Is still off though, just around 3.5%. All right, well, let's get you up to speed on the currency action here, driving a lot of the losses that we're seeing play out in the equities markets. You have the strong dollar, clearly a headwind here for the market. The dollar index once again moving higher today. Jared Blickery has a closer look at that for us. Hey, Jared.
Hey there. Well, let's take a look at our heat map, which has to do with the currencies. And all this green and dark green is the U.S. dollar strengthening. This is the 5-day price action. I'm just going to show you what happened today only. The British pound up 3.7%. This is an astounding move by cable here. By the way, this is inverted. Usually we look at the currency cross upside down, but 25% over the last year means a lot of consternation. And I'm going to show you the max chart. Now, we go back to the early 2000s, but you can go all the way back to about the 1980s. We haven't seen a price here since the 1980s. We're talking about Margaret Thatcher. And what that means for all these currencies is more pain. And when we have these highly leveraged currencies, guess what? Institutions are forced to deleverage and sometimes sell their good holdings for bad holdings in order to raise cash for potential margin calls. So let's take a look. I just want to show you. I'm writing this up for the weekend, and I have a graphic here prepared. Here we have the Argentine peso and the Turkish lira tied basically for the top spot, weakening against the dollar by about 40%. Then we have the krona over in Sweden and the yen. Now, these are two developed market currencies. And when you have this kind of action in foreign exchange in these markets, as I said, forced deleveraging could cause more pain. And we're seeing that play out this week with the Nasdaq heading to the lowest price, the Dow heading to the lowest price since November of 2020. All in all, not the best week for currencies and much less equities, guys.
All right, thank you, Jared. Let's get over to Inez Ferre, who has a check on oil. Energy just absolutely crashing today. Hi there, Inez.
Yeah, Dave, and crude closing out its fourth consecutive week of losses. Let's take a look at our Wi-Fi interactive board. We're watching WTI, which closed below $80 a barrel at $78.74, its lowest close since early January. On a technical level, it could be heading towards $75. Then you're looking at Brent crude, down more than 4.5%, closing just above $86 per barrel. Why the declines? Well, the strong U.S. dollar that Jared was just talking about, worries of a recession as central banks raise interest rates, and China still has that zero COVID policy, a big concern for demand going forward. Looking at some other energy products, we're looking at gasoline futures, which today also declined by more than 5%, and also natural gas punching below $7. In fact, a 12-day chart, you can see that natural gas is down almost 17%, guys.
All right, thank you, Inez. Well, let's take a look at the broader markets and bring in Evercore ISI Senior Managing Director Julian Emanuel. Now, obviously, we heard Jay Powell saying, look, these inflation-reducing tactics, they're going to come with some pain. How much more pain do you think can the markets expect, then?
Well, look, this has been an historic week in many respects because Chairman Powell, in talking about that pain, basically endorsed the idea that the Fed's base case is a recession in 2023. And what you have right now is the market in the midst of increasing the recession probabilities. So if you look at the average bear market, a non-recession bear market tend to average down around 27.7%. The average recession bear market, that number is closer to 41.5%. So we are in the midst of beginning to discount at least the rising probability of recession. From our point of view, we think there's likely to be a clean break of the June lows across the major indices. And then we'll just have to take it from there. The market is in an emotional phase, which is why investors have to try not to let their emotions run rampant as well.
Julian, what are the levels that you think we need to fall to before we start seeing a relief rally?
So again, in the S&P 500, there's major support at around 35.85. And that is a level, the 200-week moving average, which really only gave way momentarily during the pandemic, and where we would expect to see certainly some buying support come in. But more important to us, and this is very, very much something that we're focusing on, in a year where stocks and bonds have correlated as positively as they have in this very risk-off environment, what we're really looking for is starting to see a bid to longer dated bonds. Because if you think about it, inflation expectations being subdued, the Fed telling you that there's a greater probability of recession should draw buyers into bonds at these yields And if that's the case, that's the beginning of where stocks stabilize.
Julian, how high do you expect bond yields to go with the 2 and the 10, both the 10-year highs?
So look, the 2 and the 10 are two distinctly separate concepts right now.
Sure.
And frankly, the fact that the curve isn't inverting to an even greater degree is somewhat surprising to us. We'll have to see how that evolves over the next week, because the market still assigns a very high probability of the Fed hiking by 75 basis points in November. And to us, that is likely going to be, let's say, under review as the data evolves and as the markets remain in this emotional and agitated state. So I wouldn't expect a lot more upside to yields in the near term.
And we're obviously seeing global central banks moving at different speeds, trying to get inflation under control, really trying to spur growth. How much is that going to weigh on what the Fed is trying to accomplish here in the US?
Well, and this is really one of the peculiarities of 2022, is that the rest of the world almost feels as if the market is intentionally ignoring the stresses overseas. And look, the Fed's mandate is really to deal with price stability and full employment in the US, but effectively we all know that the Fed does tend to act as the world's central banker. And at some point, all of these stresses that are manifesting themselves in the stronger dollar, and particularly this week in surging higher gilt yields in the UK and much wider credit spreads in Europe as stresses intensify there, are going to become an issue. And to us, it's probably less a matter of exactly what the price catalyst is and more along the lines of whether there's a potential news catalyst in terms of event risk over the next week or so.
Julian, if you're an investor out there, you have cash on the sideline right now, what should you be doing?
So this is, again, where you really have to re-examine your long-term investing goals. And I would say that if you have cash, you certainly want to start dipping into fixed income here. We do think that's attractive. And then, look, what you have to think about in terms of your equity allocation is, we're right at the lows. Think about how you felt as an investor when we made those lows back in June. If you can't see yourself buying into new lows, and when I talk about new lows, I mean, call it down 10% increments after these new lows. If you can't see yourself being a buyer there where you should be a buyer there, because buying the dips has worked for literally decades, and we do believe that's going to continue, then you just want to hang tight or frankly, perhaps shift a little bit out of stocks and into bonds, because as I said, we do think bonds are very attractive here for the first time in over 3 years.
Mm-hmm. Julie, any concern that the Fed's going too fast here?
Lots of concerns that the Fed's going too fast here. Look, the thing is that if you think about it, in a lot of ways, the Fed has been really focused on not making the mistakes that were attributed to the 1970s. There was a Fed chair in the mid-1970s that cut rates in the middle of exceptionally high inflation to stave off what was then an accumulating recession. That had the effect of prolonging inflation for the rest of the decade. The Fed is cognizant of, but actually may be reinforcing the potential for it to happen by being so aggressive to fight inflation without seeing whether there's enough sort of tightening in the system already to show that inflation could, and we believe, is starting to slow, so that you've put so much tightening in the system that you're actually forced to cut, the mistake that it doesn't want to make, before it conclusively you have this turn down in inflation. We are very concerned that the Fed's gone too far, too fast.
Medicine takes time to kick in, doesn't it? Julian Emanuel, Evercore ISI. Appreciate you, sir. Have a good weekend on a very difficult day for the markets. All right, just getting started here on Yahoo Finance Live. Still coming up, Some of the biggest names in tech have been hit hard in the third quarter. We'll tell you what to look for in Q4. And the Fed's hawkish approach to combating inflation is dragging down the price of Bitcoin. We'll break down a very interesting week in the crypto space. And hot inflation also reshaping investing strategies. Learn what Gen Zers are doing now to stay afloat. Stick around. We're at the end of the third quarter, just a week away now, mercilessly, and the Nasdaq down 30% year to date. Let's look back at how some big names in the tech space performed and what's ahead for Q4. Tech reporter Dan Howley with us here with what we hope is maybe a little bit of optimism down the road. Hey, Dan.
Yeah, maybe a little bit further down the road than we would like, but let's talk about some of the big names in tech and how they performed. We look at the biggest one, obviously Apple. They are suffering, but not suffering as badly as some of their competitors. They're only down year to date about 15% as far as stock price goes. They announced their new iPhones as well as their new Apple Watch and those AirPods. There's hope among analysts that into the holiday season, they'll see good sales of this, at least steady sales. It's the iPhone 14. They're hoping that it matches up equally with the iPhone 13 as far as sales volumes go, especially in China and the U.S. We've also seen, obviously, Amazon take a big hit. That company's stock price, that's down around 32% year to date. They took a hit throughout the year because of some of those issues that we talked about with the actual sales side of things, the e-commerce side of things, where they weren't performing as well as during the pandemic, and they expanded largely to meet the demand from the pandemic. And so now they have to scale that back and kind of recalibrate. We also look at Google. Obviously, they've been hit as part of the kind of rearranging that's going on as a result of Apple's privacy changes in iOS 14. That stock price is down around 30%. Meta, that's really been slammed. That's going back to that Apple privacy change. They're down around 50% year to date. And then we look at something along the lines of an NVIDIA, which is also down more than 50% year to date. They've been slammed as a result of the chip issues that have been ongoing, as well as their forecast that they're not seeing as robust sales as they wanted to prior to their most recent quarter. They had announced changes there. It's all across the board here. Microsoft down as well. That's looking around 29%. And then we can look at, obviously, next to the S&P 500, the only one that's looking good is Apple, which is actually trending above it.
All right, Hallie, thanks so much. Certainly a brutal year, brutal week for tech. Let's talk a little bit more about the downturn that we've seen and what we could expect going forward. We want to bring in Ray Wang. He's Constellation Research Principal Analyst and Founder. Ray, it's great to see you again. Dan was just talking about some of those individual movers here, some of the larger players within the tech space that have clearly had a very troublesome 2022. Today, looking at the Nasdaq, now it's below 11,000. I know that was a key level that you were watching. What's your takeaway from the selling that we're seeing once again today?
Yeah, it's a bad day when everyone's talking about you're just a little bit about your 52-week low. And that's kind of what we're talking about at the moment. And a lot of it's really the rate hikes. There doesn't seem to be the Fed. Doesn't seem like it's going to pivot away from the strategy. They're definitely taking the Volcker approach and going head on trying to address this. The challenge is it's really a policy issue. It's not really a Fed policy. They can't do much for headline inflation, which is food and energy. And now we've got wage inflation that's picking up as a result. So I think we've got some time here before that we're going to see some rates dropping. But this is also another way to look at it. It is still a good time to buy. I know it sounds crazy, but I'm looking at companies in the Matana stocks that are large double-digit operating margins, that have a lot of cash on hand, and a number of those stocks come into mind.
And we love that Matana acronym there. What about the weakest performers in that group? Who are you most concerned about?
Yeah, the one I'm most concerned about is NVIDIA, and it's really about trying to get the chip demand back into space. Part of the reason is they had a real good run when there was a lot of cryptocurrency mining that was going on. They have a good run when there's a lot of work in terms of gaming, and of course, when data centers are doing well. I don't think the data center piece is going to collapse. I think the data center piece is actually growing as more and more people move their workloads into the cloud. The GPU thesis is still very strong. It's just that they've been compensating for a lot of headwinds, anything from regulatory environment, in terms of chip export, technology exports, to what's been going on the broader scale in terms of, overall consumption and overall economic recession fears in APAC, which hasn't picked up.
Ray, what's the investor story ahead for Apple, and how significant are the new additions? We can go back to the phone that is in stores now. I know the watch for the athletes is there, and the new AirPods as well.
Yeah, no, the Apple story is actually going to be the bright light among the Matana group for a lot of reasons, right? The fundamentals are there, right? You've got 1.2 billion devices. You've got something like 800 billion devices that have not been onto 5G yet. There's more demand for the iPhone 14 than there was for the 13. And we're seeing them pull all the stops from the carrier discounts across the board. They're also in really good position, $202 billion of cash on hand. They're highly profitable with about 39% operating margins. And this super cycle is going to help, right? The watch, right? I've got one on right now, right? I don't have the Ultra, but you're seeing a lot of people choose Apple because of features like the ability to use SOS with satellite connectivity, or really the ability to do fall and crash detection, or the ability to integrate back to the healthcare pieces that people worry about, much more so in the post-pandemic phase. So they're in really good position. They've done a good job building their services revenue, which we think is going to hit more than 25% in the next 2 years. So overall, they're in one of the best spots.
Certainly are a number of reasons to be bullish on these names here in the long term, Ray, but taking a look at the shorter term, right, because there are still a number of headwinds here. We have high inflation, we have rising rates, we have the fact that we've seen a pullback in ad spending. I guess, what is it going to be? What is the catalyst that it's going to take to really turn things around for the sector?
I think the biggest catalyst are really things that I don't really get excited about. The fact that we're going to have unemployment rates go up, or the fact that, we're going to have more recessionary numbers, right? So all the negative numbers are required for us to get out of this hawkish Fed stance. They're not things we get excited about, but they have to happen before things stabilize, right? Right now, if you've got cash, you would probably going to be holding on to it for just a little bit longer, or you might be getting 2-year notes, right? To wait until the market gets better. But there's still a lot of opportunities in the market, but you're going to have to figure out which are the quality stocks. You're going to be picking stocks as opposed to going to categories. For example, if you look at the FedEx situation, that is really a FedEx situation as opposed to a global kind of indicator. It's 2/3 FedEx, 1/3 global. And I think people have to realize those types of nuances when they're looking at the stocks.
And Ray, what about Tesla? What about the EV space? What are you watching there?
Well, what I'm excited about Tesla, and as we've talked about many times, is that Tesla is not an automobile company. It's a tech company. And what they're doing is they're positioning themselves as not only the key stock in everyone's ESG portfolio, but also a vertically integrated market. Their ability to take anything from the battery to the final production of the car to the data collection brings them new opportunities. For example, they can do their own underwriting for insurance, which I know that they're heavily jumping into. Their ability to use computer vision instead of LiDAR to actually do autonomous vehicles and be able to actually do that mapping and identify obstacles, put them in a better position than many of the autonomous vehicle manufacturers. Their ability to actually have their own power production in terms of the batteries, in terms of being able to do their battery plants, gives them a huge advantage to everyone else. And with the mandates that are coming to get to electronic vehicles, depending on the state and the country where you are, right, they're in a very good position to be able to ramp up production. And so we'll be watching to see what their production numbers are and how they compare.
Always great to get your take on tech. Ray Wang there. Thank you for joining us and have a great afternoon. All right, well, one of Shakespeare's most famous lines starts with "What's in a name?" Well, for Ford, it's a lot. So much so it's become a bit of a production problem. We'll explain after the break. It's time for Triple Play, the three stocks that we're watching in the final 30 minutes of trading. We have Tellurian, Ford, and JetBlue. So my pick, Tellurian, which is ticker TELL. Now, the US liquefied natural gas developer. Now, trading was actually halted several times today. The stock currently down about 13%. At one point, it was down, though, about 40%. Now, that's after the company disclosed it scrapped LNG supply deals with two of its biggest potential customers. Now, first you have Shell PLC, which delivered a notice to cancel its agreement to purchase LNG from two of Tellurian's driftwood LNG export plants. And then you have Tellurian cancelling a separate driftwood LNG deal with global energy trader Vital SA. Now, Tellurian would have about 30 million tons a year for each company for 10 years under that deal. Now, this comes just days after withdrawing $1 billion high-yield bond sale to fund construction of its $12 billion driftwood LNG export plants that were planned for Louisiana. Now, CEO Sharif Souki says he has shifted his focus to finding a strategic investor for that project. He said, quote, "It sets us back, definitely. It puts in jeopardy the ability to deliver gas on the schedule that we were hoping to stick to. We would never put in jeopardy, though, the balance sheet of Tellurian to try to accelerate the process by taking disproportionate risks." But obviously a big blow there, and the stock being punished for it today, Sean.
Yeah, certainly, Rochelle. The termination of the deal, obviously a huge concern here for the company. It hasn't performed that well. It's been trying to get this project off the ground for about 6 years. Now there's calls from investors to potentially have the company put itself up for sale. It dropped just over 44% actually in earlier trading. So it's clawed back some of those earlier losses, but certainly many questions just about where this company goes from here. All right, my pick today is Ford. More supply chain issues for the company, but this one you probably didn't see coming. Now, the Wall Street Journal is reporting that Ford can't get its hands on enough of the blue oval badges and nameplates that go on the auto giant's vehicles. Now, it's impacting Ford's top-selling F-Series pickup trucks. Supply chain issues clearly have been a huge challenge for this company. Earlier this week, Ford warning that up to 45,000 vehicles will be put on hold this quarter due to missing parts, saying that inflation-related costs would total just about $1 billion here, more than they were expecting for the current quarter. Day. Now, the badges, I just thought it was interesting because we don't know whether or not the difficulty getting badges here, whether or not that plays in to the shortfall that Ford is expecting to see this quarter, but it is just another headache here for the company that certainly has a number of challenges here for them over the coming months.
Yeah, we're not sure exactly how many of the Ford F vehicles, their best sellers, were missing that. But in the midst of every crisis lies great opportunity. I say sell them minus the badge as a limited edition Ford F-150 pickup. That's the way, in this market, they'd probably fly off the shelves. But seriously, if you look into it, it sounds as though a company they deal with, Tribar Technologies, had to limit operations back in August because they disclosed to regulators that they actually discharged chemicals into the local sewer system, and that's what slowed production for that company that they contract that out to. That's at least if you read between the lines on this story, so maybe no huge deal. My play is JetBlue, symbol JBLU, shares slumping today on another union report. The International Association of Machinists and Aerospace Workers said it would file an application for a union vote for JetBlue's 3,000 ground operations workers, and that includes baggage handlers, of course. JetBlue's pilots and flight attendants are already unionized. A vote could come while JetBlue is in the process of trying to acquire budget airline Spirit Airlines. More than 80% of their employees are already unionized compared to JetBlue's 46%, a huge gap. This is just the latest unionization effort that's been sweeping big business. We know about Starbucks, Amazon, Apple. Even Gallup reported lately that the approval of labor unions, highest in the U.S. since 1965, even though union membership has been relatively flat in decades, actually. JetBlue shares down about 4% on this day. I think about 3.5% now, down more than half, though, year to date. Rochelle?
I mean, I guess it does help that Spirit already has unionization in place, so it wouldn't be so much of a shock to the system if this transition does happen. But obviously, this is a growing trend that we're seeing. And you raised that interesting point about the flatness of people joining these unions, while the public opinion, though, is still very pro-union. So an interesting dichotomy there, Sean.
Yeah, it will be interesting to see whether or not this could potentially cut into JetBlue's efforts here to cut costs. We heard that from the company in the most recent quarter, just in terms of what they want to see play out over the coming quarter. So if a large portion of their workforce does unionize, obviously it could be a cost headwind here for JetBlue in the near term, but we'll see how this all plays out. All right, coming up next, CEO of Slack telling us how his platform is looking to take video meetings to a new level. Stay tuned. About 25 minutes to go in the trading day, and take a look at where things stand. You can see we have bounced off the lows of the day. The Dow now off 555 points. We were off over 800 points at the lows of the session. S&P still off just around 2%, as well as the Nasdaq. You can see the Nasdaq falling below 11,000 today on a weekly basis. Has certainly been an ugly week here for the markets. All three of the major averages on track to close the week lower for their fifth weekly decline in the last 6 weeks. All right, we have been covering Salesforce's big Dreamforce conference this week. Well, Yahoo Finance's editor-at-large Brian Sozzi sitting down with a Slack CEO Stuart Butterfield and getting his take on what it's like being a leader in the tech space, the company's integration into Salesforce, and the future of work. Let's take a listen.
I make this argument. It goes like this. If in March of 2020, in some parallel universe, we were allowed to keep on meeting in offices, traveling for work, using conference rooms, commuting, all that stuff, but you took away the software, then every large enterprise would have just disintegrated. Like it would have ceased to exist in 24 hours. I find this very compelling evidence that we, as a matter of objective fact, kept going and even thrived in many cases through the pandemic, despite the fact that we couldn't go to the office. But if we were allowed to go to the office and you took away the software, it wouldn't have worked. So there is this, we say digital HQ as a marketing term, but there is this digital infrastructure that supports productivity and collaboration that's really essential, that from my perspective, I think people have underappreciated or underinvested in because it's intangible, because it's invisible. And like, if you were a manufacturing company, you're relentlessly looking for ways to optimize the factory floor and the productivity. We don't do that so much for knowledge workers. So this is a long answer to your question, but I'm just starting to see that to kind of creep into the consciousness, people realizing the possibilities to transform the way they work, to rethink organizational design, management structures, peer feedback, performance reviews, all that stuff, really leveraging the digital technology that we've kind of taken for granted.
What is the evolution of Slack? So I caught the keynotes. I've talked to your chief product officers tomorrow. There seems to be a new evolution or an evolution playing out in Slack now that it's really been integrated inside of Salesforce.
Yeah, I guess there's two things. One is, you just mentioned the integration into Salesforce, and it's kind of deep across the customer 360, Service Cloud, Sales Cloud, Mulesoft, Tableau, the whole thing. And obviously there's a lot of Slack customers here, there's a lot of Salesforce customers, there's a lot of people who are customers of both, but there's a lot of curiosity about the power of that integration and kind of Slack's traditional idea that we want to be a multiplier on the value of your other software. The other thread, I think, is if you imagine starting to work at a new company where they use Slack, you can scroll back through the last 6 months of conversation in your team, you have all this archive, all this history, you can search. On the other hand, if you join a company where the primary means of communication is email, you start with an empty inbox. And if anyone wants to share any of the hundreds of millions of messages you're cut off from, they have to do it one at a time manually. So there is this accretion of value the longer an organization uses Slack. But what we want to do now is look at the 30 hours a week we spend on video calls where there's not even a receipt left at the end that says that the call happened, and start to think about what can we do to facilitate the curation, collation, collection, organization of the materials that were shared, the notes that were shared, and start to think about a different way of working live that really captures some of that value, so that in my dream, in the future, a couple of years from now, you can get invited to a meeting and you're like, no, I'll just catch it after. Because right now there is no catching it after.
Why are we still meeting like it's 2019? I just had somebody put something on my Google Calendar. It feels outdated.
There's such a strong bias towards the status quo, and I think the other part of it is at the extreme. There's like the Amazon 6-page memo format where you have to write no PowerPoint, write it all out. We're going to start the first 10 minutes of the meeting in silence while everyone reads. But we're human beings, so if you have, here's your two choices. Choice A is, carefully write out your thoughts and edit them for concision and clarity, and be careful to articulate, and all your arguments are in order. And then receive the written feedback of your peers and carefully read that and incorporate their thoughts. And the other one is option B, let's have a meeting for 30 minutes. This is like Brussels sprouts and broccoli and stuff, and this is like a Snickers bar. So people are always going to choose this easier path. So how can we make this path the easy, obvious, simple one?
Last time I saw you was Davos, and we were just starting to get these return to offices, notably at the banks, but a lot of other companies. Does that just drive you crazy? Why are we mandating people to get their butts back in the seats in the office when we have tools like yours that we don't need to be in there?
Yeah, but certainly the idea of people going back to just hundreds of thousands of square feet of desking, I sometimes say factory farm battery chicken housing for people to sit and use their laptop by themselves with the headphones on. They're not even talking to each other. That part you could do anywhere. I mean, I think obviously there's value to getting together in person. Depends on the team and the function, but I feel like there's, in the ideal world, a rhythm where you get together. Maybe it's only once a year, maybe it's every other week, and you build up a lot of work to do, you kind of prioritize things, and then the execution mode give people flexibility because they demand it. We've had the mandates get back to office, and I think, outside of a handful of smaller exceptions, San Francisco's 30% still, New York is 50%. There's not significant movement coming on this front.
Lastly, now that these platforms have been integrated, Stuart, you're a serial entrepreneur. What is it like being an entrepreneur inside of a much larger company?
It's interesting. Obviously, there's a lot more inertia. I don't mean that in a critical. I guess there's a lot more momentum, let's say. And there's like the same class of problems to solve at a bigger scale. So I think there's both additional challenges and kind of also additional opportunities. And Salesforce is in a really interesting position where I think there's a lot of top line growth left, and we've talked about a goal of 50 billion in revenue by fiscal 26, but also really significant improvement in margins. Going from 20%ish now. 25% in that same time frame, that'll have a huge impact on the bottom line.
Do you miss being a public company?
I don't know if I missed this particular 6-month period.
You don't miss our chats for earnings?
I do miss that, but gosh, the last 6 months have been pretty rough. I got a lot of public company CEO friends, and it's tough.
Do you think we're near? I'm not saying to predict stock prices or bottoms here, but what is going on out there, and what is it going to take for some of these tech stocks to just come out the other side? I mean, is demand that bad to warrant some of these sell-offs?
I think the multiples have probably come down to something that looks pretty reasonable. A lot of, I think the average even for software across the board is something like 5x forward revenue, which is, compared to, I don't even know what the average was, 18 or 20x or something like that at the peak. I think the open question for investors is still, do we see a change in demand and therefore an actual change in performance? Because the multiples are probably about good, and if we collectively determine that we're not going to see a real decrease in demand, we're not going to see a real decrease in economic growth, then I think we have a lot of upside from here.
Stuart Butterfield, the Slack CEO, with Brian Sozzi out west. Thank you, guys. Coming up, the CEO of Uranium Energy Corp says it's time for the U.S. to end its reliance on Russian nuclear fuels. He joins us to explain how this can be done when we come back. With Vladimir Putin ready to ramp up the war in Ukraine and having already fully weaponized the country's energy, is now the time to look inward for the future of nuclear energy. Admir Adnani is the founder and CEO of Uranium Energy Corp. He joins us now. Amir, nice to see you. How reliant is the world on Russian uranium, and is there a solution within the United States?
Way too dependent on Russia, and absolutely there is a solution in the U.S. First of all, the U.S. today is the largest consumer and importer of uranium in the world. We have the largest nuclear fleet anywhere in the world that's generating emission-free electricity. 1 in every 5 homes in America is powered by nuclear energy. The biggest source of supply coming into the U.S. is from Russia and countries that are very much still under the influence of Russia, Kazakhstan, Uzbekistan. And so we need to be able to get our uranium, just like our pharmaceuticals, just like all supply chain issues that we need to control, we should be able to get it from our own backyard. And absolutely, there is a solution for it in the US. And, you know, look, my company, just over the last year and a half, we've made almost a $500 million investment in purchasing physical uranium on US soil, acquiring the Uranium One company that many people might be familiar with from the Russian government before their invasion of Ukraine. We stepped up and after a very long process, we're able to repatriate those assets and bring them into US ownership, our company, and have even made acquisitions recently into Canada, which we see as being way more politically aligned with the US and having more of the same values as Russia, which you simply cannot rely upon for a source of something as crucial as uranium, which is a very strategic energy commodity.
Well, Amir, when you talk about this transition, the U.S. becoming more independent in this space, I know the Biden administration has been wanting to wean the U.S. off of Russian uranium imports. But I guess, what are the 2 or 3 steps that we can do over the coming months here in order to slowly make that transition?
Maybe it's got to be made faster. I don't know about slow, because here we have on one end, clearly the White House sees there's an issue, right? They asked just a few weeks ago, they asked Congress for a $1.5 billion emergency funding to give those funds to the Department of Energy to procure nuclear fuel, uranium conversion enrichment. So clearly they see there's a problem. And that 1.5 is part of a bigger $4 billion discussion around how to create more energy and national security by having our own fuel. There's a proposed bill in the US Senate right now with a companion bill in the House that's calling for a ban on Russian uranium imports. We need to make sure US utilities get on board with this. US utilities need to understand that their addiction to cheap Russian uranium is something that can be rectified with domestic supplies that could be here and developed and become a long source of very stable and really creating economic prosperity in our own backyard while creating a very secure source of supply. You need to get US utilities on board, because if they also support this bill in the US Senate and the House and say, fine, rip the Band-Aid off. Why have we banned everything else coming out of Russia, like oil and gas? Why is every major US company pulling out of Russia, but yet we're still dependent on their nuclear fuel and uranium, and we're still doing business with them on that? Isn't that sending a mixed message?
I mean, Elon Musk would certainly agree. He said it's actually insane from a national security standpoint and bad for the environment to shut down nuclear energy then. What do you think are going to be the biggest hurdles then in really changing the mindset about nuclear energy?
You touched on so many key points there that you're absolutely right. I mean, look, Musk came out and talked about the importance of nuclear energy in the mix. We have the highest public opinion polls in favor of nuclear energy, all-time high. We have bipartisan support. All of this is driven by what happened with COP26 and the United Nations and every other major country's commitment to net zero. And everyone realizing that you can't commit to net zero, reduce carbon emissions, if you don't have nuclear energy in the mix alongside renewables and all sources of energy we can get our hands on that could be base load and around the clock, but not pollute and put more greenhouse gases out there. So look, bottom line is, I think you have very exciting developments with small modular reactors. Bill Gates' company, TerraPowers, is looking to build the first small modular reactor in Wyoming. You have really a record number of small modular reactors on the drawing board to be built and developed. You've got over 60 reactors under construction worldwide. China alone is talking about adding 150 new reactors just in the next 15 years. And that will far exceed the size of the nuclear fleet in the US, which is 94 reactors. So what we need is just sensible and I think very sober perspective here, right? Which is if we're going to, in one end, reduce greenhouse gases, but on the other end, pursue electrification and put more electric vehicles on the road that need to be charged, we need 24/7 electricity. Battery storage and technology is simply not there to rely entirely on intermittent power from renewable. So we need nuclear because it's 24/7 power generation, and it's the backbone of any modern economy that wants to electrify and go through electrification while decarbonizing at the same time.
Certainly a lot of work to be done indeed. We do thank you for joining us, Uranium Energy Corporation founder and CEO Amir Adnani. Thank you so much. Have a great weekend. All right, well, coming up, it has been a wild week in cryptocurrency. We've got to look back at the biggest moves as rising rates drive prices sharply lower. Stay with us. Keeping an eye on Bitcoin, trading down about 3 1/3% today. And of course, it's been a rough week overall for the cryptocurrency. We heard Fed Chairman Jerome Powell's hawkish tone, and that had investors searching for less risky assets. So let's take a look at the interactive here, as we see that it's down 3 1/3% there. But as we look for the week, we can see where it did take that turn after Jerome Powell's comments, down about 3.5% for the week. And let's also take a look at Ethereum. A similar story there. That's down more than 3%. But of course, that's been doing even worse, getting additional pressure following the merge. If we take a look back there, and we see how that's been faring over the past month. Ever since that merge, they're dropping, as you can see, about almost 22%. Now, you also have other news putting pressure on some of these other crypto tokens. On Friday, the Defense Advanced Research Projects Agency, or DARPA, said it's launching a sweeping review of cryptocurrencies to assess national security and law enforcement threats to really crack down on illicit use. So you're seeing many of them pressured here. As we take a quick whip through, really the only one in the green at the moment is Dogecoin. That seems to be the only one that's actually doing well on the day. We see a few of them in the green. Doge there, obviously an Elon Musk favorite, but many of them still under pressure. Now, we are going to see that the IRS is also going to be digging into potential crypto tax evaders using crypto broker SFOX, and that's at the request of the Southern District of New York. So you can expect more scrutiny ahead. And of course, illicit use potential was just one of the many shots fired from JP Morgan Chase's Jamie Dimon on crypto, as he and other bank CEOs testified this week. Now, he really did re-up his disdain for crypto tokens. Take a listen.
You have to separate blockchain, which is real, DeFi, which is real, ledgers, tokens that do something and deliver information, money, ideas, simplify, smart contracts. That's one thing. I'm not a skeptic. Okay, I'm a major skeptic on crypto tokens, which you call currency, like Bitcoin. They are decentralized Ponzi schemes, and the notion that's good for anybody is unbelievable.
So he's a fan of blockchain, though, and he did say that the bank actually uses it, but the individual tokens he's described as potentially just insanity at this point, Shauna.
Yeah, Rochelle, the wild ride in Bitcoin this week clearly reflected in some of those crypto stocks. We can see Coinbase, it was lowered its price target from JP Morgan there down to $60. That stock getting hit today. Block getting downgraded by Mizuho earlier this week, slashing their price target from 125 to 57. So that really reflects the broader crypto environment right now and all that selling pressure that we've seen play out in the crypto space here over the last couple of months. All right, coming up, we are counting down to the closing bell on Wall Street. Again, all three of the major averages in the red this afternoon. Dow off 560 points. We'll be right back. We are just minutes away from the closing bell, and the closing bell cannot come soon enough. Again, another ugly day on Wall Street. Jared Blickery has a closer look at this for us. And Jared, it doesn't seem to be getting that much better.
No, we're going to give this 65 more seconds. Then it's over, Shauna. The Dow is down about 4% for the week. You can see steady losses since Wednesday. That would be FOMC day. S&P 500 not far, actually a little bit more far behind that, almost approaching 5% in losses. And the Nasdaq well over 5%, or just a little bit above 5%. Here's the sector action for today. Energy really taking it on the chin. WTI crude oil closing at, I believe, about 52-week lows with a 79 handle. Haven't seen that since at least December, January, going back to about a year ago. Now, healthcare, utilities, tech, real estate, financials, all of those are the least bad shorts in the house. But I'll tell you what, healthcare was a standout earlier this week, not so today. Also checking in on some of our risk metrics. We're going to check in on meme stocks. I haven't done that recently. Tilray down 3%. We had American Airlines down 4%. Remember when that was a meme stock? Finally going to close on some of these banking stocks also taking hits. Goldman, Morgan Stanley, HSBC down 3%.
There's your closing bell on Wall Street. Brutal, devastating Friday. The market's down for the 5th Friday in the last 6 weeks. It has not been a nice way to end our weeks for the last 6. And look at that, the Dow below 30,000, first time this year, and the Nasdaq down more than 5% for the week, losing 1.8 on this day. It is a difficult one. Let's try to put it in perspective with our panel now. Jacqueline Remen, Morgan Stanley Private Wealth Management, Private Wealth Advisor and Senior Vice President. Also with us, Keith Fitzgerald, Fitzgerald Group Principal. Good to see you both. Look, this is just a tough day, Jacqueline. It's one of those days you get on Twitter and people are sharing devastating memes about their 401k. We're not just talking Wall Street. We're talking everybody down Main Street is talking about the markets. Do you tell them there's more pain to come?
Yeah, thanks for having me. When we see days like this where the market's retesting, we're talking to clients about repositioning portfolios. And what that means is positioning for the current reality that we're in, which is higher and more sticky structural inflation and rising interest rates. Talking to clients about positioning portfolios for value over growth, and looking for dividend growers, not just dividend payers, companies that are going to grow their dividends, and looking at companies with operational efficiency, strong balance sheets, and resiliency in their earnings.
So, Keith, for those who perhaps have a longer horizon, who aren't just sort of looking at their 401ks and sort of retiring in the next, 6 months or so, how should they be viewing this, and what sort of context should they look at this through?
Well, number one, I think they should take a deep breath and maybe grab a stiff drink or their favorite libation. The bottom line on a day like today is, yes, this is terrible. Yes, it's scary. But you've also got to stay into the fight, because if you've got a long-term perspective, companies like Apple, for example, are going to return to the head of the class. The only question is when. Companies like Costco, for example, are still putting up fabulous numbers, are going to be the place to shop for a long time to come. So I would submit, if you have the time horizon, the patience, and the risk tolerance, these are the kind of days where you actually do want to engage the markets and you want to run into the fight by picking up a few shares.
Keith, some of the fear that we're certainly seeing play out in the market today, what we've seen play out in the last couple of trading days, is some of that fear overdone?
Oh, I think so. There's no question, and this is a very tough point. This doesn't get talked a lot about. But what you're seeing today, where everything is red and there's no place to hide, this is really the global equivalent of a margin call. That's what's happening, is you've got big traders simply getting off the gas, walking away from the bid on a Friday afternoon because they know that retail investors are going to get scared out of their minds. They're going to panic, and it makes it easier to separate them from their money. The easiest way to play this as an individual investor is to not engage in that battle. Don't give them a chance to do that. You know what the great companies are, just like I do. Nobody's given up their iPhones. Nobody's given up their Microsoft Teams. They're continuing to stay in the fight. Those companies are going to put up good numbers.
Boy, I'd love to know what you're drinking to shake off a day like this. Jacqueline, what can be the catalyst? Does Keith have a point that it's maybe oversold? And what can be the catalyst to recover in the weeks ahead?
Yeah, for long-term investors, we're looking for opportunities similar to, what Keith said. Companies that are staples, that are going to be around, have strong balance sheets, operational efficiency, increasing their dividends. Within the tech space specifically, we're looking for that kind of tech staple, like the toothpaste of technology companies that are more defensive, especially with recurring revenue streams. And then more broadly, across the different sectors, looking for opportunities for companies that are retesting their lows similarly to where they were in June, that present long-term opportunity for growth.
And Keith, I want to ask you about the pace of tightening, because one of our guests earlier said that they were very concerned that the Fed was moving too fast, too soon. And obviously we had questions there to Jay Powell asking if he was not really taking enough time to see if what he was doing in terms of CPI and watching inflation was keeping up with what was actually happening in the real economy, given the lag. How concerned are you about the Fed's pace right now?
Well, there's really two answers to that, and I don't mean to be disrespectful, but I think the Fed is as wrong about rates and the decisions it's making today as it was about the transitory narrative. It doesn't understand the asymmetrical impact that it's having on real money. So I think Jay Powell is doing lip service to the rest of us by saying he wants us to feel pain and this will be good for us and they've got to slow the economy down. Put it in plain English. The Fed wants you to lose your job and they want to crater the economy because that's how their models work. A rational person would say the stove's hot, don't touch it again. So I don't have a lot of respect for what Jay Powell's doing right now. That's not to say it's not important, but I'm going to look to the CEOs. I'm going to look to the companies that I know are going to be there because that's what consumers are going to decide. And consumers, like it or not, control the real money here.
Well, Keith, when you look at the CEOs, when you look what companies have been doing, yes, we have certainly seen a slowdown in hiring in some of those bigger companies that we've been closely tracking. But the labor market remains very strong. Even looking at the claims number that we got this week or the past couple of jobs reports that we're getting, Bank of America was out with a note today saying that the fact of the matter is that claims are still running at levels indicative of a very tight labor market, showing very little signs of cooling off. I guess, how much more do you see, or how significantly do you see the unemployment rate rising here before we start seeing inflation cool a bit?
I don't think it's going to. I think as long as the federal government continues to throw money into the system, the Fed can't fix this. The Fed has a fiscal problem, not a rates problem. Employment, I think, is tremendously misunderstood because what's happening is those statistics are set up to measure an economy that existed 100, 120 years ago. The nature of how we work, where we work, and why we work is changing. The gig economy, the increasing reliance on tech, those are all things that are not being properly reflected in how tight or how loose the economic market is, the job market is right now, in my humble opinion. I may be completely wrong, but the way I look at it, I still see plenty of people who want to work, I see people who need to work, and I see a government that is at the people, not for the people, and not by the people.
Right, well, a big thank you. We'll have to leave it there. Our market panel, Jacqueline Remen and Keith Fitzgerald, thank you both for joining us this afternoon. All right, coming up, can the Fed chairman pull it off? Jerome Powell says the chances of a soft landing are, quote, likely to diminish given the Fed's fight against inflation. But diminish isn't zero. We'll look at what this will take for the US to avoid a recession next.
Investors are reeling as central banks around the world raised rates sharply this week, and has some wondering how much lower stocks, bonds, and oils can go. Yahoo Finance editor-in-chief Andy Serwer is here with us. And Andy, I know you took a look at a number of bear markets in the past. How does that compare to what we're seeing today?
Well, we don't know, and we won't know for years. And, of course, there are all manner of bear markets and downturns. Of course, 2008, 2009, the Great Recession, the tech bubble in 2000, the crash of 1987, the crash of 1929, flash crashes, and all the rest. But what scares me the most, Shauna, is a period actually that encompasses the 1970s. It's the 1970s and then some, where the market went up, it went down, and went up, and went down. But for 16 years, look at this chart, 16 years from 1966 to 1982, the market point to point did nothing. Went from 1,000, the Dow 1,000 to 1,000. 16 years, and it was because of inflation and because the Fed wasn't fighting inflation. Inflation came from the Great Society programs in Washington, D.C., a lot of government spending, number one. Number two, the Vietnam War. Number three, the oil shocks and rising oil prices. So that's the one that scares me the most, number one, because it's so long, and number two, because it's eerily, like today, another upcycle with rates.
So Andy, how bad was that roller coaster? Were there any glimmers of hope? Did any stocks do well?
Yeah, Rochelle, it's funny. I mean, first of all, it was bad. I mean, you could have gone from pre-K to high school and the stock market never went up. I mean, think about that. That is a long time. Now, having said that, it really, there's some things to look at internally there. First of all, the S&P 500 had a dividend yield of 4.1% annually. So you were getting paid that way. And then there were some stocks that did okay. I mean, you had to avoid the go-go stocks of that period, the Nifty 50, which were stocks like Polaroid, Eastman Kodak, and Xerox that were expensive going into the 1970s. Perhaps eerily like our FANG stocks today. Think about that. And then there were stocks like Johns Manville, an asbestos maker in the Dow. That did, of course, really poorly. But stocks like, Altria, the Philip Morris, the tobacco stock did okay. Exxon did okay. And then consumer non-discretionary stocks, in other words, consumer staples did very well also. And then as well, so if you looked at companies with yields and companies that sort of fit into those camps, you did okay.
Andy, Dave here. As I mentioned earlier, it's one of those days where you look on Twitter and Instagram and people are actually talking about their 401ks. They're talking about the Dow. So what does everything you just put in context for us mean for most of us?
Yeah, I mean, Stan Druckenmiller, the legendary investor, Dave, was talking about how, he actually mentioned 1966 and 1982 and saying how it looks pretty similar in terms of it, as I was saying to Sean earlier, another cycle up for rates. Of course, another thing's going on right now is globalism is falling apart, and that actually spurred a lot of stock market activity to the upside as well. So I think that, the parallels are scary and eerie. And if you look at the Nifty 50 stocks and the FANG stocks, that's similar as well. So I think you have to really kind of take a look at your portfolio and ask yourself, are all your stocks, overvalued? Are you in companies that are in bad shape? Do you have yield in your portfolio? Do you have stocks of companies that people are going to be buying their products no matter what? And your guest was just on talking about that, including some companies in the tech space with the recurring revenue of subscription. So don't necessarily think those big tech stocks are bad. I think it's a real time to look at what you have and maybe even consider looking again. Remember, CDs and savings rates, those are going to come back into vogue. It just depends on how long this upcycle is, Shauna, whether it's going to be 3 years or 16 years. Yeah. And we don't know. I mean, your kid will be in high school.
I know, that is a scary thought, yes.
Right?
But it certainly is a very different investment environment today and likely over the coming years, like you were just saying, than what we have been in most recently. So people need to adjust their portfolios as a result. All right, Andy Serwer, great to have you on set. Thanks so much.
Thank you.
Rochelle.
All right, great stuff. Well, with the new Fed forecast out, investors are debating the chance of a soft landing for the economy. Now, Yahoo Finance's Rick Newman has that story. Rick, how's it looking?
I think these last 2 weeks are a pivot from believing that we might be lucky enough to get a soft landing to no, we're not going to get a soft landing. It's going to be a hard landing. I look at dozens of economic reports every week, and that seems to be the recurring theme this week. And let's just spell out what we're talking about here. A soft landing would mean that the Fed manages to get inflation under control, and unemployment doesn't really go up very much, and the economy doesn't contract. So now what investors seem to be thinking, and this is reflected in the wipeout we're seeing in markets this week, is no, in order to get inflation under control, unemployment is going to have to go up. Bank of America, just as one forecaster said, they think by the end of next year, unemployment rate will have risen from 3.7% right now to 5.6%. That is the pain that Jerome Powell, the Fed chair, has been talking about. So this does not automatically mean we're going into a recession, but I think what we're seeing in markets is a belief that the odds of recession are certainly getting a lot higher.
And Rick, like most of us, Jerome Powell needs skill and he needs luck. And say he gets a little luck, the end of hostilities in Ukraine, what would that mean for all of us in avoiding a hard landing?
So what's going on in Ukraine mostly affects energy markets. And it's really interesting because oil prices, I mean, we've been talking about it all day. Oil prices, which went well over $100, over 120 over the summer, based on fears of what might happen in that war, now below $80. So we've seen oil coming down surprisingly low. Now, natural gas is a different story. Europe's having a big problem there. But this inflation story does not seem to be emanating from Ukraine anymore. It seems to be things that are built into the supply chain and labor costs. So this is the reason you hear the Fed chair talking about, I mean, he says it obliquely, but we just had a guest say, the Fed wants more people to lose their jobs because then demand for a lot of goods will soften and prices will come down in theory. So it's very perplexing. And, this is all happening at a time when consumer confidence actually has ticked up recently. And the reason that has happened is because the number one thing consumers care about or seem to care about is gas prices. So gas prices are down. People have been feeling better about that. And President Biden's approval rating has actually gone up. And now we're seeing this turn in markets. So we just can't get it right here.
That does seem to be the trend. A big thank you there, Rick Newman. Have a great weekend. All right, well, coming up, new data shows that there's one thing younger millennials do more than any other generation when it comes to their finances. We'll tell you what it is after the break.
Might not be a huge surprise on a devastating day like this for the markets that nearly 1 in 5 has closed an investing, trading, or brokerage account in the past year. The highest concentration among those closing accounts, millennials and Gen Z, in responding to an Ally Financial survey. So is now the right time to stop investing? Jason Dorsey is a Gen Z researcher. He's also the author of Z Economy. Good to see you, Jason. So why are, in particular, Gen Z and even millennials stopping investing right now? Is it due to inflation?
Yeah, absolutely. It's due to inflation and the pressures on their income, right? They're having to draw down on whatever savings, draw down on their investments. Plus, you got to remember, Gen Z never been through a market like this. Many of them opened the accounts during the pandemic. They saw it go up, and many thought it was just going to go up. All of a sudden, it's going down. So we're seeing them close their accounts right now. We're seeing them move into more defensive positions, and at the same time, rents are going through the roof, which disproportionately affects these younger generations. And one of my favorite things is that in our new study with Envestnet, people think millennials and even Gen Z aren't interested in finances. But in our new national study, younger millennials, ages 25 to 35, were the #1 generation to look at their total net worth in terms of frequency. They were looking at their total net worth more than Gen X, more than baby boomers, you name it. So I find it interesting that so much, as you know, of the headlines is millennials aren't into finances, Gen Z doesn't care about money, and it turns out they're looking at it more than any other generation. Yes, it gets me fired up because I think this is one of those key insights we need to share.
Well, and it should get you fired up, especially on a day like today, and especially since this is the younger generation, a generation that should be concentrating on building their wealth. So if they are closing investment accounts, obviously that could have huge implications for their financial positions down the road. I guess talk to us just a little bit more about the potential fallout from this, and also where Gen Z is going for financial advice. Is it the traditional route, or are they more likely to go online?
Yeah, so the fallout from this is going to be, in my opinion, massive for the younger generations if they don't get back into the market. The idea that they'll eventually be able to retire without starting to save and invest right now is just not going to happen. They have to take action today. So whenever I'm talking with millennials and Gen Z, I'm like, yes, the market's going to go up, the market's going to go down, but you have to stay a participant. We have time on our side. We may not see it, but we do. So we need to take advantage of that longevity and ride this out. At the same time, where are they going for advice? I love this. In that same Envestnet study, we found, and this is a shocker, we found that the #1 place where millennials wanted to go for trust when it came to financial advice and financial help was a human financial advisor, right? I say this because they told us we still trust a human being to help us with our finances more than anyone else. That's important. Now, when you get to Gen Z, we see some differences. Gen Z, it turns out, they'll go to TikTok, what we call FinTalk, to try to get advice. And I'm always like, well, that could be entertainment or it could be advice. You gotta be careful. But the key thing for me is all the advisors watching right now, you have a clear role to play. People need you, and I would argue more than ever, particularly in choppier markets, because you don't know where to go and how to sit this out and the emotional roller coaster. That's why millennials and Gen Z, I believe, need human financial advisors now more than ever before.
So Jason, in terms of the trends of what younger investors are investing in, what do you see there?
Yeah, well, they love to go after the growth stocks, first of all. You know, anything that's tech related, they know it, they like those brands. Of course, many of them now have a hangover from that experience, right? It's been pretty hard to write it up and write it down. The other thing we saw in the study was that Gen Z, and in particular millennials in the national study with Envestnet, millennials were the generation most interested in crypto and the generation most likely to own crypto. And we dug into that because, you know me, I want to know why. That's my big thing. And what we found is that millennials, when it comes to crypto, feel they better understand it, which is so interesting. But if you think about it, it's always been through a mobile device. It's somewhat easy to follow, right? It goes up, down, stays the same. At the same time, they don't have to get into all these underlying details about profit and PE ratios and all these different things. They really understand it. It's almost gamified in terms of investment, if you really look at it from an interface. So that's why we see them really leaning into crypto. They tend to better understand it. And by the way, which isn't talked about often, you can invest very small dollar amounts now, which is what we saw all throughout the pandemic. So we see a real overweight towards tech stocks, which again bore a lot of the challenge right now, and also towards crypto. And if you put that together, you can see why 1 in 5 Gen Z and millennials are closing their accounts right now. Right? It's been a rough time, but we got to get them to stay in.
It certainly does make sense, doesn't it? Want to shift from the investment strategy to another Gen Z study from UCLA, Jason, that says some enlightening things about how Gen Z views content. Here are some takeaways. Only 4.4% prefer aspirational content. Aspirational stories, 4%. Another, they overwhelmingly want to see a white male villain if they are watching such a story. And finally, 55% view social media as the most authentic platform, and traditional TV weighing in at 2%. What's your broad takeaway from any of these observations?
Yeah, well, they're great ones. First, let's look at aspirational, because I dug into this study. I believe it's called Teens and Screens 2022. Shout out to UCLA for that great study and name. What we saw when we looked at aspirational is that was more life of the rich and famous, right? That's how they define aspirational. And a lot of teens, and we've seen this in our State of Gen Z study, it's in my Z Economy book, they don't want that. They don't aspire to that sort of materialism and sort of show-offness, if you will. And so as we saw, they were not inspired by it. They don't want to see that. They can't relate to it. And many of them are saying, that's not my value system. Big shift there, by the way, during the pandemic. What do we see about the villains? Look, I'm thrilled when we see teens say, well, we need to see diversity of all kinds, everywhere, in all roles. Like, that's just a shift that needs to happen, and it's so exciting to see that in that national study. And when we look at authenticity, what do we know? Well, we've done a lot of work around authenticity. And when we saw it in the study, the way we tend to assign authenticity a value, and this is super cool, because I get asked all the time, how do you define authenticity? And we've done all these studies, and people say, oh, it's being authentic. Well, we dug into that because that's not really an answer. And it turns out that authenticity to Gen Z means vulnerability. And many of them feel like they can get vulnerability through social media. And if you look at the social media platforms that have really taken off, many of them are not the perfectly polished, Instagram types, but we're seeing more stuff on Snapchat, even things on TikTok, like where people, you can see more of what they're really like. And I know that there are some generations watching right now going, oh, these young people today, they shouldn't trust social media. I always like to say, well, who should they trust? I know, Yahoo Finance.
Fair point. There you go. Perfect answer. You raised a very important point about the content. It has to be authentic. It has to be relatable. Otherwise, you just feel disconnected from it. So lots of good points and great takeaways. Jason Dorsey, thank you so much for joining us this afternoon. All right, well, the Fed's recent rate hike could be having an impact on your credit card. Yahoo Finance's Kerry Hannon is here with the details. Kerry, what are you keeping an eye on?
Well, hi, Rochelle. Up and away, as they say. This is, credit card rates go in tandem with the Fed rate increase. So it usually takes 30 to 45 days before you see it. But right now, the variable credit card rates are already almost at their all-time highs. It's the highest it's been in 27 years at 18.1%. By the end of the year, the experts I've talked to say we're going to easily top 19%, which would surpass the all-time high, right? So this is something to pay attention to because credit cards charge 3, 4, 5 times what other consumer credit like mortgages or car loans are. So it's really important that you get to paying these things off now because it is really, since the beginning of the year, Rochelle, percentage rates have climbed close to 4 percentage points since the start of the year. So consumers are really feeling the bite, and particularly those who are carrying this debt. This is who we're talking about, the variable rates month to month. And a recent study by creditcards.com says that 60% of people say they've been carrying debt revolving month to month for over a year. So, now is the time to really buckle down and pay attention.
So, Kerry, for people out there who do have debt, they want to pay it off, they want to do that quickly. What are some of your tips on the best way to do that?
Yeah, really. Okay, so if you qualify, look to see if you can get one of these balance transfer credit cards, right? This can be a 0% percentage rate for 21 months or so, and it gives you that pause button where you can start paying down. Then it will adjust back up. But if there's a small transfer fee of maybe 3 to 5% in order to switch your balance to one of these cards, but really look for one if you can, because that will give you some breathing room. Number 2, of course, do a budget. What can you do? Start on a payment plan and do automatic payments so you're not late, that you're more than the minimum payment at least. So you can whittle away. Some people look for consumer loans. That's a possibility. It's definitely going to be a lower rate if you can qualify for one, around 6%. And the final thing is, if you're really in a pinch and you're really backed into a corner, there are nonprofit credit counselors out there who can help negotiate with your credit card issuer. And the Department of Justice has a link on its site to ones that they have vetted. So that's what I would suggest to people. But really, this isn't the time to let this keep snowballing, because it is a huge domino effect.
Very important info for people out there who are looking to lower their credit card debt. Carrie Hannon, thanks so much. Have a good weekend. Well, coming up, it is a question many Americans are asking. Should I get a COVID booster and a flu shot at the same time? What the experts are saying after the break.
Well, if you're looking for the Moderna COVID booster in your local pharmacy, you may be offered Pfizer's instead. Yahoo Finance's Anjali Kemlani joins us with the details on the latest supply issues. Hi, Anj.
Hey, Rochelle. So what we know is that Moderna hit a little bit of a snag with its manufacturing partner Catalent. They had an issue on site in the same facility, but not with the batch of Moderna vaccines, and that's delayed the release of those doses into the market, according to the FDA. The company did tell us in a statement that they are working with the U.S. government, and they expect that they will be able to deliver those bivalent doses as they continue to see high demand, also noting that they will meet their 70 million dose promise to the U.S. government. So nothing seems to be too off point. This is not the crisis of shortage that we would have seen a year ago. This is simply a matter of one company being unable to meet the timeliness of the demand right now. But we do know that, of course, we have Pfizer on the market as well. So it is, once again, not the same issue as before. The issue should be resolved shortly. And the CDC has recommended either of the doses as a booster. You can mix and match. There have been studies to prove, in fact, that mixing and matching actually does have a little bit of a benefit there. So a little bit of a setback for anyone who's looking specifically for the Moderna one, but not for very long.
Anj, we can feel it. The fall is here, which means the flu is right around the corner. And questions of whether we should get a flu shot and a COVID booster at the same time. What are medical experts saying about that?
They're saying in not these terms, but more technically, it depends on how much of an ouchie you want. It depends on whether or not you're willing to sit through the 2 doses in one arm or 1 dose in either arm. But the result is get both. That is the recommendation. You should be able to get both at the same appointment. You can separate them if you want, but it is advisable to get those doses, especially the flu, before the end of next month, before the end of October, which is when flu season really starts to take off. Now, it's really important to point out that there was a concerning flu season in the southern hemisphere. They just finished their winter and are getting into summer. And so that has indicated to the U.S. that there might be some issues there to keep an eye on, and maybe a harder flu season than we saw in the last years. The pandemic and all the mitigation measures like masking and isolating really helped to keep flu at bay. But now that we're, returning to somewhat of a normal, we might be seeing a harder flu season this year. So the answer is, in short, definitely get both. Try to get them at the same time. And if it's too much for your arms, separate them.
So go for the double ouchie is what Anj is saying. Thank you so much. All right, let's get over to Shauna now for the movers of the week, and mostly to the downside, huh, my friend?
These certainly are some of the biggest stock stories here. There was too many, so we picked out the top 3. First, let's start with Ford, because it recorded its biggest intraday drop in more than a decade earlier this week. Shares sinking over 12% after the automaker said that inflation-related costs would be about $1 billion more than they had initially expected during the current quarter. A parts shortage forcing Ford to delay deliveries, warning that it could actually impact up to 45,000 vehicles during the third quarter. For the week, you can see the stock off just around 16%, ending the week at $12.31 a share. Next up, let's talk about FedEx unveiling a cost-cutting plan and rate increases as it tries to navigate a weaker economy. Now, the packaging giant planning to cut costs by up to $2.7 billion this fiscal year and up to $4 billion by fiscal 2025. Analysts, though, they're a bit skeptical on FedEx's plans. Morgan Stanley writing in a note that, quote, detail was lacking. The team at Citi warning that they don't think management was successful in convincing investors that it was a credible plan to execute on. Taking a look at FedEx, the stock off just about 7% in the past 5 days. The news broke during intraday trading yesterday, and you can see the selling continuing today as analysts weigh in and investors are trying to gauge how big of a potential challenge this is for FedEx. All right, rounding it out with Moderna. Now, investors dumping vaccine stocks after President Biden saying that the pandemic is, quote, over. Shares dropped as much as 10% on Monday. The stock kicking the week off on a very rough note, warning out there that demand could fall for the vaccine slowly as a result. Now shares closing the week off just about 10% at $123.64 a share. Dave?
All right, Shauna, thank you. Here's what to watch next week. Monday should be pretty quiet, but needless to say, after a disastrous end to the week, we'll be seeing if stocks bounce back. On Tuesday, we'll get durable goods orders and another glimpse at housing with the Case-Shiller Home Price Index and new home sales. Also, earnings from Cracker Barrel and BlackBerry. Thursday, we'll get final Q2 GDP figures. They're released as our initial jobless claims. We'll also get some earnings with Bed Bath & Beyond. Don't expect good things there. Rite Aid, CarMax, and Carnival reporting as well. This all leads up to the all-important end of the week. PCE reading on Friday, as well as the University of Michigan Consumer Confidence Index. And with that, the end of Q3. So a pretty eventful week, but hopefully we will see some bounce back in the markets. Coming up, Aaron Judge's next shot at Yankees history, American League history, will air tonight on Apple TV. Plus, hear what Yankees legend Derek Jeter told Yahoo Finance about the future of streaming in the sports world. That's next. Yahoo Finance's editor-at-large Brian Sozzi had a chance to sit down with Mulesoft Chief Product Officer Sean Close at Dreamforce 2022 this week, where they discussed the integration software, the company's role in the business world. Here's Soz.
As you can see, everybody here at Dreamforce is talking about how can they have a 360-degree view of their customer and grow efficiently. Everybody's looking to figure out how to automate while still delivering an incredible customer experience. And the average enterprise has to do that on top of about 950 different systems. So imagine you're AT&T, you're a large telecommunications company, or a bank. You're trying to deliver great customer service on top of those 950 different systems. Mulesoft helps you make those systems work as one. So it's a great place to be. You know, once you integrate those different systems, you end up being able to deliver your projects about 75% faster. It's just dramatically better, good place to be.
That was under 2 minutes. That was really good.
Thank you.
What is your biggest challenge as you look forward to next year?
I guess the question is the big challenge that all of us are facing is exactly how to do what I just described, which is achieve digital transformation and do so with less, right? We're all trying to do more with less. Obviously, we're facing economic headwinds, inflation, the workforce challenges. Everybody's facing all those challenges, and so they're all trying to figure out, okay, I know I need to continue meeting the needs of my customers, but how do I do that efficiently, right? How am I going to actually achieve that? Again, on top of those 950 different systems. And so our challenge is helping our customers do that. Our challenge is helping them deliver value from all those things so that their customers continue to get their needs met over and over again.
You guys, Mulesoft, got a nice shout out on the last earnings call a couple weeks ago. It feels and it seems like there's a turnaround brewing. Sales are accelerating. What is driving that?
Yeah, I mean, the simple case is that in the end, the real world is very complex, like I said. And most enterprises are really complex and getting more complex, and still trying to deliver incredible customer experiences. And so Mulesoft has been doing for about 16 years, we have been helping organizations take all of those different systems and complex environment and connect it all together so that they can have a 360-degree view of their customer. So for Mulesoft, kind of this is us in our prime. We're doing exactly what we have always set out to do, and we're doing it as part of the broader Salesforce, which obviously has hundreds of thousands of customers, where we can surface all of this data to drive a really better customer experience.
I was talking to Salesforce's co-CEO Brett Taylor about the platforms integrating a lot more. It seems like there's more collaboration between a Mulesoft a core CRM customer and also a Slack and Tableau. Is that a fair assessment?
Absolutely. We're working to make certain that all the different capabilities of all those things you talked about, Tableau, Slack, Mulesoft, and Salesforce, all work together really seamlessly. Let me give you an example. Some of our customers, in fact many probably listening to this interview, still have mainframes with green screens, right, that are holding important customer data. Like if you were at the IT keynote, many people were clapping when we were talking.
I don't think we could stream on those computers.
Yeah, I'm pretty sure they don't do video, but regardless, they have all of this important customer data and capabilities in their mainframe. So how do they take that stuff and put it in beautiful digital experiences like mobile apps or in service experiences in Service Cloud? So we released a new tool called Mulesoft Robotic Process Automation that does just that. It takes those mainframes, UI-driven experiences or PDFs or images, it gets the data out of those things, and then it surfaces them up for use inside, for example, Salesforce, where it can be automated using Salesforce Flow. You can run workflows off Slack. You can see that same data in Tableau. Realistically, like the whole idea is to bring this one view of the customer and all of these capabilities together. It's better together.
I think that's what you're talking about. The team has been talking about a single source of truth.
Absolutely, a single source of truth. One place to go, one place to understand what the customer looks like, what they want and what they need. And with Salesforce Genie, which you heard us talk about a fair bit, and I assume others have been talking to you about, we are making this all real time. So that when something happens, you know, your vehicle breaks down or your bank account is overdrawn or you become a VIP with a retailer, when that happens, we can respond in real time. We can send you a gift. We can send somebody to fix your car. We can notify one of the account teams that supports you to call you and tell you that it's okay and we're going to figure it out for you. We're bringing it all together to truly deliver an incredible customer experience. That's what makes moments truly magical. Moments are magical when they respond to what's happening to me as a customer, me as an individual.
Bigger picture thing, what, in this era of automation, it's only going to increase, what role do humans play?
I mean, humans will always be needed to deliver those beautiful human magic moments. Like humans are best when they're creative, when they're making smart decisions on behalf of their company and on behalf of their customer. So what we really want to do is we want to take away the drudge work. We want to take away the repetitive rote work that employees are forced to do, which doesn't really add any value. You know, there's flipping from one system to another. They're copying and pasting data from one system to another. You know, we worked with AT&T, and AT&T were automating some of the work that's done by their B2B sales team. And did you know that they automated a few of the key workflows? They saved 30 minutes per rep per day. I would love to have 30 minutes back myself.
I got to push, Sean, I need somebody on the phone if I call up.
Yes, but that person is still answering you on the phone, but instead of putting you on hold for 30 minutes, they're instead being able to use a system that means they can answer your questions immediately. And that means AT&T saves 1 million hours every year of their reps' time so they can serve you as a customer.
And thanks to Brian Sazzi, who's out there with Mulesoft Chief Product Officer Sean Clowes out at Salesforce Dreamforce event out on the West Coast. All right, a big story in the sports world and also in the world of streaming. All eyes are going to be on Apple TV as New York Yankees outfielder Aaron Judge chases home run history. Yahoo Finance's Josh Schaefer has been following this story for us. And Josh, this is a huge night on multiple levels. Obviously, a big night for Judge himself, but a huge night for Apple as well.
Right. So here's kind of the situation, right? So Aaron Judge is 2 home runs away from breaking Roger Maris's AL record for the most home runs in the American League. And that record goes back over 50 years to 1961. So it's a big deal. But you can only watch that game on Apple TV Plus. So Apple started, this is their first year with Friday Night Baseball, as we know. And they have this game, they've had this game for a long time, so it's Red Sox-Yankees tonight, and you can only watch that game on Apple TV Plus. It will not be on a regional network like, say, a Yes Network, ESPN. At one point earlier in the week, it was, will ESPN be able to break into this? No. The answer is this is Apple and MLB, so Apple is getting kind of their first primetime moment. And of course, we know baseball's a little old school, right? A lot of people aren't pumped that this is only going to be on a streamer. And I think that that's something that's been an interesting discussion to watch play out. And I actually recently sat down with Derek Jeter, the Yankees legend and baseball Hall of Famer, and we sort of chatted about that, among other things. Derek's currently working on a project called the Arena Club, and that was what we were there talking about, which helps fans with memorabilia in that space. And I was asking about fans, though, as well, when we talk about streaming and getting into new things. And so I said, is MLB getting into streaming really the right thing? And here's what Jeter had to say.
You have no choice. I mean, the way the game's consumed nowadays is a lot different than it was when I was growing up. I don't want to date myself, but you know, people are walking around with their phones, and that's how they're watching, and they want to watch it at their own pace when they have a moment. So yeah, I think it's all about the evolution of the game.
The biggest thing that stands out to me there, you hear Derek Jeter talk about walking around on your phones. Think about tonight. Aaron Judge is playing in this game. We really only care about when Aaron Judge is batting and when he's going to be swinging for the fences, right, Dave? We only want to watch those at bats. Apple TV provides that with that app. You can watch that at any time. You can be at dinner tonight with the family and watch Aaron Judge. And I think that's why streaming's probably good.
Yeah, I absolutely agree with you. I mean, I do understand the frustration from those Yes and Nesson fans that are going to be very angry tonight. I didn't expect the New York Attorney General to be among those angry. She calls it wrong and unfair that this game is only on Apple, even though, just to point out, it is free. You don't have to pay the $5 a month for Apple TV. All you have to have is an iCloud Apple ID. Josh, what about the AG's complaints here? What do you think? I
think it was wrong, right? She said that you had to pay. She said specifically to pay extra if they want to watch this exciting home run chase, and that's fundamentally not accurate. The MLB and Apple have both put out statements and told people how to get Apple TV Plus. If you can get access to that app, so if you have Wi-Fi and a smartphone or a smart TV, which a lot of people do nowadays, you can watch this for free. So I think it's going to be a big move probably for Apple because it is free. It's going to get people into Apple's software and onto Apple TV. And I think that that could be a big night for Apple guys. What are they going to watch after that? Are they going to maybe watch an episode of Ted Lasso or get interested in Apple TV Plus because they're watching this?
Yeah, it could be a good play there for Apple. Josh, are you going to go to the game?
I won't be there.
You won't be there?
It's my Red Sox, too. It's my Red Sox.
I know. You were the perfect target. I thought maybe you were going to fork over all that cash in order to go.
$1,500 is a lot for a ticket.
Yeah, it's a little steep. All right, Josh Haber, thanks so much. Rochelle?
Well, make sure you don't end up taking that phone to dinner. At least give people a heads up if you're going to do that and ruin their dinner plans. Well, on to some other sports news today. Tennis star Roger Federer is playing the final match of his career today. Now, the 20-time Grand Slam singles champ is playing doubles alongside friend and rival Rafael Nadal. The match is part of the Laver Cup, which pits European players against others from around the world. Now, Federer helped create the tournament back in 2017. I mean, this is a tough one. I absolutely adore tennis, so it's sad to see him go. But I mean, looking at his career, $1 billion in career earnings before taxes and agent fees. That's more than twice of Rafa Nadal and Novak Djokovic. But I mean, the man is a legend. This is going to be hard to say goodbye. For sure.
Hard to believe he made twice as much as Serena Williams on and off the court. I think if that was today, Serena would probably make every bit as much, if not more. Really tough spot for the sport of tennis, replacing the two greatest stars of a generation. I don't know how they will do it. Coming up, employers around the country are asking, how do we get workers to return to the office? Well, at the famed Seagram building in Manhattan, they said, let's have a real estate developer do it for us. We'll show you what a $25 million playground looks like next. Numbers out this week show return to office reaching a post-pandemic peak of just 47.5% in 10 major metro areas, leaving employers across the country wondering how in the world do we get workers back in? Well, perhaps they should recall that lesson from Field of Dreams more than 30 years ago. If you build it, they will come. That's what developer RFR Holding did in building a $25 million playground inside the famed Seagram building in Manhattan.
Is probably considered the most copied office building in the world. It set a whole new standard.
Since it was built in 1958, the Seagram building on Manhattan's Park Avenue has inspired similar designs around the world. 64 years later, developers are copying its former parking garage. Now a $25 million playground.
We're trying to create a community here, trying to get people to socialize again, come out of their rut, and trying to establish some sort of a culture, a work-life balance culture.
The signature is a 22-foot climbing wall with 10 different skill levels. There's a full-court basketball and pickleball court, fitness center, spin room, game room, even a theater for those ready or forced to return to the office.
We're helping out by, giving you an alternative to sitting in your bedroom or sitting in your office at home versus coming here and having a pickup game with your colleagues.
The one critique about the playground, employees may never actually make it to the office.
Many spaces in office buildings used to be a cliche. We don't like working with cliches. We want to do something that's outstanding, that's different. When Mr. Rosen, who's the owner of the building, he said, we either do something that's extraordinary and, just wows people, or don't do it at all.
Extraordinary indeed. The amazing thing is they dreamed this concept up pre-COVID, even though it's serving as a model for office buildings around the country coming out of COVID. And Shauna, they had 250,000 square feet of vacancy when they converted that parking garage. It's been leased up 95% at a time where office buildings are relatively empty in New York City. A huge success.
It is a very huge success. You're right. 49% of New York City workers are back in the office, so just less than half. Maybe if more offices had facilities like that, they would be more likely to come back to the office. Dave, real quick, were you tired after that shoot? They had you playing about 10 different sports out there.
I could stay all day. That's my dream, man. I would never leave work.
For me, unless there's food included, I don't think I could do it. But that'll do it for us on today's Yahoo Finance Live. But be sure to come back Monday at 3 p.m. Eastern for more with Yahoo Finance Live. Dave, Shauna, and myself will see you then.